various investment proposals. So for telecom network for AMC, which is at a cost of about 164 crores. Also for Western Region Expansion Scheme, which is at a cost of more than 115 crores. And approval for ICT augmentation at Navsari, which is at a cost of about 110 crores. So Shri Cement over there, Shri Cement East Private Limited has commenced trial production at its clinker grinding unit in West Bengal, which is at a capacity of 3 metric ton per annum. With this, the total cement capacity for Shri Cement has gone up to 49.9 metric ton per annum in India. Back to you.
Okay, all right. Those are all the stocks that are on our radar today. Let's talk about the F&O space now. Nigel is joining us with cues from that space. Hey, Nigel.
Well, morning, Sonal. You know, we've been gaining for the last 3 sessions. Can we make it 4 in the row? Well, that's something that we'll be looking forward to. The big cues really will be the Fed, the progress of the monsoons, earnings season, as well as the HDFC merger. So those are the top 4 cues that we're looking out for in this series itself. How the FI is positioned? Well, they position net long. Close to around 66% of their positioning is on the long side. And if you look at the net long positions, I'm talking about the longs minus the shorts, where it's at around 56,000 contracts, which is much better than we saw at the start of the last series of close to around 20,000 contracts. The problem is the PCR has moved to the upper end of the range at around 1.41 odd. Remember, the range is close to around 0.7 to around 1.4. And we have seen in the past when we go to 1.45 odd, that's when we see some bit of profit taking. So let's see how it goes this time. It seems the bulls are feeling very, very confident because now, in fact, the put writing is really taking center stage. And just take a look at the big open interest build up on the put side. And the call side, well, it pales in comparison to the put side. Now, you need to stay long on this index. But I think just for today, taking some money off the table at the gap up will be something that you should be looking at going by the cues. But if you're looking at stop loss and on the downside, what should the support levels be? I think the 20 DMA is an important level. So the SGX Nifty should come up for you on the screen. We have had 3 good series. This morning as well, it's suggesting some bit of green to kickstart trade. I think take some money off the table, have an early weekend. Back to you.
Okay, all right. Thank you so much, Nigel. So those are the cues to watch out for today's market session. Let's slip into a short break. Up next, we'll get you all the updates on TCS, that is the tax collected at source, as the government postpones implementation of new TCS rates. Stay tuned for that.
To talk about the current position of Biparjoy, we are being joined by Mr. Sunil Kamble, IMD Head Mumbai. Thanks a lot for talking to us, sir. My first question to you is about the latest position of the very severe cyclonic storm, sir.
See, if you see the latest position on map exactly, you can see that northeast Arabian Sea, we can see the eye of the cyclone, and that cyclone is likely to move towards Kutch coast, and I mean it is likely to hit on 15th evening between Mandvi and Karachi.
Right, and that's a landfall, right? So
yeah,
it's going to make a landfall
that is called landfall. So we are expecting landfall on 15th of afternoon.
So this image is this was taken at around 12:49 p.m. 13th June. This is the position of the cyclone, and so this particular cyclone was pretty unpredictable. It obviously, you know, posed a huge challenge to IMD also to forecast its path. If you can help us understand the trajectory, the track of the cyclone.
See, if you see this picture, you will come to know on 6th actually low pressure formation took place. On 6th itself, it has converted into the cyclonic storm, and we named it as a Biparjoy. And after that, it has become the very severe cyclone on 7th. Until this black, if you can see the black, it is the actual track of how, or the trajectory of the cyclone, how it has actually traveled. And at present, as on today, the position of this, cyclone is here. And what is the prediction? How it is likely to move? You can see with the red dots how it is likely to move. And as per the IMD forecast, this cyclone would like to have the, landfall on 15th between Karachi and Mandvi.
Right, so there are too many twists and turns when it comes to the path, because started northwards and then northwest, again northeast, and then again northwest, and again going to come
Yes.
back to our coast again. So my next question to you is about the impact of this in Mumbai. Is Mumbai going to witness any impact of this particular cyclonic storm?
See, at present, cyclone is 700 kilometers away from Mumbai, and because of the impact of cyclone, we are likely to have the strong westerly winds at the speed of 40 to 50 kilometers per hour, gusting to 55 till next day. And because of this, we may have light to moderate rain at all the coast like Thane, Mumbai and Palghar.
But nothing alarming, right, sir?
There is nothing alarming. Light to moderate rainfall will take place because of the impact of this cyclone, and wind will be around 40 to 50 kilometers per hour till next day.
So Biparjoy is not going to impact Mumbai and the nearby region in any massive way. But talking about the advancement of monsoon, so we all are waiting for that. So when can Mumbai expect the onset of monsoon?
See, if we talk about monsoon, you can see the monsoons have advanced till today, till Ratnagiri. And as this cyclone is approaching towards north, heading towards Gujarat, at the same time we will have a southwesterly wind pattern. And
Welcome back. You're still tuned into Power Breakfast on CNBC-TV18. Let's get you some updates from the TCS EGM that was held yesterday. The first under new CEO K. Krithivasan. The TCS top brass spoke of a macroeconomic overhang throughout the year. CEO Krithivasan said they returned over 90% of cash generated to shareholders and recorded a strong order book throughout the year with a total contract value of $34.1 billion. Chairman N. Chandrasekaran warns of downside risk to global economic growth and says that AI and machine learning will have a profound impact on business. The Tata Sons chairman also expressed deep pain over the job scam that emerged at the IT major. Okay, with that, let's move on from this TCS to the other one, that's tax collected at source, as the government has postponed the implementation of the new tax collected at source under the liberalized remittance scheme to the 1st of October from the 1st of July earlier. The Finance Ministry has also said that there will be no change in the tax collected at source for payments up to 7 lakh rupees, while in an important clarification, it also says that overseas credit card transactions won't be counted under the LRS scheme and hence will not be subject to TCS. Well, this is a big update that came yesterday, so we'll keep tracking that for you. But let's move on. Market regulator SEBI cleared an array of proposals at its board meeting held on Wednesday, which include halving IPO listing time to 3 days from 6 days at present. The board also approved making additional disclosures mandatory for certain FPIs. SEBI chairperson Madhapi Puri-Pooch in her press conference said that the issues around mutual fund TER regulations were discussed extensively in the meeting. Let's listen into what she had to say.
Proposal was discussed in depth, and the board finally advised SEBI to go back and publish it as another consultation paper. Reason being that, as I had mentioned earlier in some forum, that unlike our normal proposals which are done by way of co-creation with the industry, since this was a price-sensitive subject, we did it with the limited data that we had and without the benefit of the data that the industry had. So once our consultation paper was there, then naturally industry came back with their granular data. Now when we saw that granular data and said, okay, we now understand this, so therefore a lot of the things that we had built into and baked into our original proposal needed to undergo a change. We modified the proposal, and the proposal was actually, I think the industry would be quite pleased to see the new proposal. And therefore what the board said was, look, the proposal has undergone significant change because, as we described, we had more data, new data, and therefore we obviously, as I've always said, that the data will speak. So our policies will always rely on data. And therefore the board advised us that publish your new proposal, which you have put to the board, publish it again to the industry, and let us see now with this fresh proposal, which is quite different, let's see what the feedback is.
Okay, important update there. Of course, we'll analyze that as well for you. But time for a short break. When we return, the Reserve Bank of India released the Financial Stability Report for June. We get to the details on the other side. Stay tuned.
accordingly we are expecting that maybe in next 48 hours we are expecting this monsoon will further advance in rest of the Maharashtra.
Right. So as the pressure will, as the system will move forward, that is going to be a favorable condition for the
onset of monsoon.
For onset of monsoon. So another thing, talking about the rainfall which we are expecting, especially Maharashtra, how is June looking like, sir?
See, as per the long range forecast, we have issued that monsoon will be normal. And especially in the month of June, we are likely to have some deficit 20 to 30% rain in Maharashtra, especially central Maharashtra. And how rainfall will be there in the month of July, that forecast we are going to give at the end of June, last week of June.
Right, sir. And this is also the month when, you know, sowing happens. So this 20 to 30% deficit, you think it's going to impact that, or is it way too soon to comment on that, sir?
Actually, it is very too soon to comment on it. We'll just wait for the onset of monsoon over Maharashtra, and then accordingly we can give the advisories to the farmers.
And in Mumbai, any tentative dates, sir, as in what IMD expects? When is IMD expecting monsoon to reach Mumbai?
See, actually, Mumbai's onset date is 11th June, but now already 11th June has crossed, and all of us know that monsoon arrived at Trivandrum itself on 8th.
Right.
So, and because of the impact of this cyclone, we are not getting the moisture, or all moisture is getting sucked by the cyclone. So we are waiting to when the situation will improve, and we can tell everyone that when the monsoon will arrive at Mumbai.
Thanks a lot for talking to us, sir. So a lot depends on Biparjoy. Once this system will move forward, IMD will have more clarity on when exactly monsoon is going to reach Mumbai. In Mumbai, with camera person Milind Wagmare, this is Santya for CNBC-TV18.
A wind speed of almost 50 to 60 kilometers per hour, light drizzle. We are in Jamnagar, which is just adjoining Dwarka, which is one of the worst affected areas, expected to be hit due to the cyclone, which will make a landfall on 15th of evening. Now, remember, today heavy to very heavy rainfall was experienced in several low-lying areas of Gujarat. Several measures are being put in place, even as it is expected that the wind speed will only rise tomorrow and day after tomorrow. Day after tomorrow, it's expected to cross over 135 kilometers per hour. Along with heavy to very heavy rainfall in several locations on the coastline of Gujarat. As of now, the situation in Jamnagar, where we are around 50 to 60 kilometers away from Dwarka, which is going to be in the line of the cyclone when it makes the landfall, the situation here also seems to have been affected. We have been experiencing some heavy gusty winds along with a drizzle at several locations.
Welcome back. You're watching Power Breakfast on CNBC-TV18. RBI's financial stability report shows that the stressed assets in the banking system have dropped below 4% as of March this year. It is expected that the asset quality will improve below 3.6% by next year in the baseline scenario. My colleague Ritu Singh brings us more clarity on this.
Well, the big takeaway that comes through from RBI's financial stability report is that banks are well capitalized and capable of absorbing any macroeconomic shock over a one-year horizon, even without any additional capital infusion, and bad loans could actually fall in the baseline scenario assumed by RBI. Now, the regulator paints a very positive picture of the banking system outlook. The capital adequacy of banks and the CET1 ratio currently at historic highs, the gross NPAs at a decadal low of 3.9% with net NPAs at 1% as of March, and the macro stress test that RBI has conducted assumes certain levels of macro shocks to the economy to ascertain how resilient the system is, and finds that gross bad loans of all banks could actually fall from 3.9% as of March to 3.6% by March next year in the base case scenario, and rise marginally to 4.1% in the medium stress and 5.1% in the severe stress scenario. Now, if you break that up across various bank categories, Public sector banks could see their gross NPAs rising from 5.2% now to 6.1% by March next year in the worst case scenario, or improve to 4.8% in the baseline case. Private banks could see their gross NPAs fall to 2.1% in the baseline case and rise to 3.8% in a severe stress case. Similarly, for foreign banks, NPAs could rise in the worst case to 2.6% by next year. Now, in terms of capital adequacy, the stress test results show that banks' capital adequacy overall could fall from 17.1% now to 16.1% in the baseline case and 13.3% in the severe stress test case. However, none of the 46 banks will breach the minimum capital requirement of 9% in the next 1 year, even in a very stressed scenario, although 7 banks could fall short of the minimum capital when you include the capital conservation buffer in the severe stress scenario. For NBFCs, RBI has taken a sample of 135 large ones, and in the baseline scenario, their gross bad loans could rise from 3.4% currently to 4.1% by March next year, and in a severe stress scenario, it could even double. In terms of capital adequacy, it could fall to 24.4% in the baseline case, 23.8% in the medium case, and 23.5% under severe stress. As many as 5 NBFCs could fail to meet the minimum regulatory capital requirement in this severe scenario.
Ritu, thank you so much for joining us with all those details. With that, we'll take your leave on this edition of Power Breakfast. Stay tuned. Bazaar Morning Call comes up next.
At Garuda Aerospace in Chennai, a new batch of drones is ready to be shipped out. The startup clocked 50 crore rupees in revenues from drone sales and services in FY23 and is now prepping for an order of 8,000 drones worth 323 crore rupees. Incidentally, these are only the drones received under the Kisan Drone Yatra, where farmers use drones to not only transport their produce to market quickly, but for crop assessment, digitization of land records, and spraying of insecticides and nutrients. With orders pouring in, Garuda raised $22 million in Series A funding in February, the largest mop-up by an Indian drone startup. These shipments, Garuda says, will catapult revenues into uncharted airspace.
We are looking at a very progressive and conservative target of about 450 to 500 crores next year, because we already have 320 crores of drone sales waiting to be realized.
Experts estimate that the farm sector alone could place drone orders worth 8,800 crore rupees in FY24. Orders from defense, big energy, shipping and steel companies could account for orders worth an additional 16,000 crore rupees. This has drone companies and their investors scrambling for more orders, more capacity, more efficiencies and more investments. The Indian drone market attracted investments of close to $50 million in FY23, and this in itself was 3 times the total investment that came in over the previous year. And it isn't just startups, but the more established companies as well that are gunning for a place in this pecking order. The opportunities, they say, lie across the board, from operating drones for agricultural and manufacturing applications to making them for the armed forces. Companies expect the market for both drone procurement and drones as a service to multiply many times over, and they want to ride that slipstream. In Hyderabad, security and surveillance firm mCloud has forayed into drone manufacturing. After executing drone service orders for energy and manufacturing majors, it is now targeting 2,500 crore rupees in FY24 revenues from drone sales. In this, it is banking on the 70% stake it acquired in Bengaluru-based drone maker Scandron in March. Scandron makes 200 drones a month. But mCloud says this isn't enough. It is looking for land parcels in Hyderabad or Bengaluru to expand operations.
The manufacturing capacity has to be drastically changed to scale. Right now, we should be able to manufacture about 200 drones within a month's time. We need at least 10 acres of area because of the flying testing that we have to have, and different, if we have to scale to deliver like thousands of drones within a month.
Meanwhile, Mumbai-based IdeaForge is readying for a bumper IPO as it looks to deliver high-altitude drones to the armed forces. And in Chennai, IIT-incubated E-Plane is scaling up its production after receiving design organization approval from aviation regulator DGCA. There are over 100 drone manufacturers in India and even more drone component manufacturers. Every week, more such companies are taking off as they race for a piece of the market that promises clear skies and fair flying weather. In Chennai, this is Jude Sanath.
Today's Indianomics is on the transformation of Bank of Baroda over the past few years from a relatively ignored stock into a darling of even foreign funds. The current MD and CEO Sanjeev Chadha.
This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming out of a holiday, midweek holiday, but right into the last day of the week. This is, by the way, the end of the week. It's the end of the month, the end of the quarter, and the end of the half year as well. So, it's interesting in that sense, but perhaps has got some implications for, how funds behave, etc. We'll talk about that. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Nigel and Rima. Guys, hi, morning.
Morning.
Hi, end of the month also means salary, right?
Wow,
I
Rima.
thought you would say that.
I thought you'll leave
You
it
can't
for me.
keep...
But yeah, good to come out of a holiday and get into another holiday,
This
right?
trading day was pretty much sandwiched in the midst of two holidays, but salary comes in. And plus, I'm sure everyone's mutual fund portfolios are looking a lot better now with the kind of rally we put in.
Oh, absolutely, right? I mean, all-time high portfolios,
Yeah.
hopefully, for everyone.
I think the rains could give it a bit of a break on the weekend as well. It's been raining too much.
So, I want to say this again. As someone, I can't get over it. Someone said, I don't know why there is Saturday and Sunday market should be open because the 0.5% daily compounding is interrupted. I mean, that's how used to people have gotten to markets doing well. But let's just quickly run through what you need to know, right? So the Nifty on day before yesterday, that is Wednesday, closed above the all-time high, the previous all-time high of December 22 of 18,888. It also, by the way, got to 19,000 levels and kind of ended just under it. That's the point number one. So, I mean, we are basically coming in after a session where we saw strong momentum pick up once again. How are global cues? So you got 2 days worth of data to react to. That is Wednesday US and then last night. I mean, day before US session was nothing. I mean, S&P was absolutely unchanged. The NASDAQ was a little higher. So this is yesterday's change. S&P on your screen, the NASDAQ flat. So accounting for the prior day, NASDAQ perhaps will be slightly higher as well. The Russell 2000, the broader small cap US index is up about 1.25%. So it's not as bad, the backdrop from the US. And why not, right? Data in the US is screaming hawkish. I mean, it's basically telling you that the economy is just in very good form. So we had upward revision to the first quarter GDP numbers, 2%. By the way, an economy that size, that's the revised number upwards for GDP. 2% is not recession, right? I mean, it's nowhere close to as many have been expecting for the last year or so. There is, of course, also the renewed drop in weekly jobless claims, which has kind of reversed the rise that we saw in the prior 2 weeks of data. And I think this is interesting. This basically suggests that the hawkish Fed policy, which we heard from, we got a pause, of course, which was kind of difficult to explain, but we got a pause. But after that, in commentary, we heard from Fed chair that there is more job to be done, and the data kind of reinforces that. We get core PCE numbers today, later out of the US. But unless that is something wildly different, I think we should go with what we already have. Now, market reaction, big rally in yields. The 2-year topped out at about 4.9%. I mean, it got to 4.9, that's the point. And then, of course, it cooled off a little bit. The 10-year was up 13 basis points to about 3.8. The dollar index is also up. It's up back above 103 levels. And for the last 2 days, by the way, the dollar index is creeping up 0.5%, 0.4%, and we are back above 103 levels. Now, let's just come to the levels here in terms of the market. The Nifty has resumed its higher top, higher bottom formation with what we've seen on Friday, on Wednesday, beg your pardon. So that's good news. I mean, because we had a bit of a corrective move, which was very short-lived. And in 2 sessions, we've we seem to have reversed that. On the way up, the Nifty has resistance at 19,040 levels. And then the upper end of the rising channel stands at 19,190. So those are levels that I would like to project at this point in time before we move any further. You could look at Bollinger Bands, etc., and project even higher levels, but 19,040 and then 19,190 are the 2 levels on the upside. On the way down, the support which has worked consistently for the Nifty, has been the 20-day. That now stands at 18,704. Quite a bit of distance between where we left off day before and the 20-day now. The Nifty Bank, we pointed out on Wednesday morning that on Tuesday session, it had crossed the 20-day moving average. And then the momentum in the Bank Nifty has also picked up. On Wednesday, it crossed the previous high of 44,499, but it could not sustain above it. So that becomes the first level on the way up that you need to be mindful of. On the way down, the 20 and the 40 exponential day moving averages, the levels on your screen will be important to track. The SGX will come up on your screen. As we've been saying, SGX is up about 34, 35 points or so. Momentum is very, very strong. I mean, if you're trading, it always helps to get, the risk reward skewed in your favor. And the easiest way to do it is to buy slightly lower and not, chase the gap up in any way. The market's not showing a big gap up or anything, but that's the way to do it. Otherwise, I see really no problems with where the market is or where we are headed from here. Rima.
Absolutely right. The SGX 50 is suggesting a 100-point gap up, currently closer to 19,200. Which compares with Wednesday's future close of 19,080. So we are looking at a 100-point bump up. Just a quick word on the flows on Wednesday. The FIs have net bought more than 12,000 crore rupees. Yes, it does include the Adani block deal, the MSCI rebalancing, but still, it's a very large number. And with this, the FI inflows in this fiscal year have topped $10 billion. The DII outflow was just about 1,000 crore rupees. As we enter the July series, it's going to be a very important one. One, you've got the Q1 earnings season. You've got the auto sales. Let me begin with that. The auto sales start trickling in over the weekend. Then from next week, we've got the Q1 earnings season starting with Chalet, but it pretty much picks up from the second week of July. You've got to track the monsoon progress. It started off late, but it's picked up steam. But can it sustain? That's going to be watched closely. And the FOMC meeting is on the 25th and 26th of July. In other important news, which came over the weekend, which spells good news for the asset management company, SEBI appears to have deferred its decision to rationalize the total expense ratio. They've said they will release a second consultation paper, and Madhvi Puri Butt says the MF industry will be pleased to see the new TER draft regulations. So watch out for that. Secondly, the government has also given more time for implementation of the higher TCS rates, the tax collected at source on overseas spending, also the inclusion of credit card spends in LRS. So there is more time. This was a bit of a worry in terms of implementation for banks. So just ease of doing business, some steps which appear to boost the ease of doing business over the weekend.
Well, that's right. Rima, the trend is up. Yeah. But maybe booking some profits today at the start, if you get that big gap up, may not be such a bad idea. That's the call I think that I'm making today. Can the Nifty make it 4 straight sessions, 4 straight series that it ends higher? Well, time will tell. Remember, last 3 series we've ended higher. The last time we saw 3 straight positive series was in late 2021. That was in August, to October 2021 series. So out there we did pretty well. But can we make it 4 in a row? That's the question we're asking. I've not seen 4 in a row, at least in the last couple of years or so. So let's see whether or not we can do that. In July, actually, in terms of a month-wise data, it's a favorable month. Because 8 out of the last 10 years, July has been positive. On an average, I've got a return of close to around 2.9% for the last 10 years on an average. And also in 2022, well, we had the best month in the month of July. So the seasonality factor or the data points are pointing that July is normally a good month. Let's see whether or not we get a good month this time around. How are the FIs positioned? Well, they're positioned on the long side. As I say, always we'll miss some of that short positioning because that was the start of the rally. When the FIs were totally net short, they were selling in the cash market and they got stuck on the wrong side. So for starters, at July series start, they're at around 66%. the net long positioning is close to around 56,000 contracts. So that's much higher than what we saw at the start of the June series itself. Even if we're looking at, the FI positioning and comparing it with the client positioning, clients would basically be HNI and retail. It seems now the clients, they're either hedging themselves or maybe they're not expecting the index to run away. Because now actually they're net short on the index. And we've seen in the past that they normally have been on the ball in comparison to the FIs. So the FIs, the net long positions are at around 56,000 contracts. That's the long minus the short. While the clients, well, they're short are more than the long. So the net short positioning is at around 32,000 contracts. The PCR as well has moved to the upper end of the range. Remember, it fluctuates in this band of around 0.7 to around 1.45. Now it's at the upper end of the band because the way put writing has taken place. 18,900, 19,000 put, massive open interest build-up. So in the near term, maybe the put writing has got a little bit too easy. The levels you're tracking on the downside, you need to stay long on this index. But the 20 DMA will become important both on the Nifty and the Nifty Bank. But given the fact that the dollar index is a little bit stronger, Brent crude prices have moved up a little bit. The PCR has moved to around 1.4. And also you have the FIs that are easily net long. I think if you get a gap up, take some money off the table, enjoy yourself, start the weekend early, drive to Lonavala, do whatever you want. But I think taking some money off the table at the start of today may not be such a bad idea.
Nigel, what they say about taking money off, right? You got to make two decisions, three actually. You got to decide to take money off.
Decide what to do.
Take the money off, and then you got to get back in. Yeah. But if you're trading, that's what you do.
Yeah,
right?
That's purely the call on the headline index. So I thought one of them will be what do you do with the money?
No, you keep it because you got to get back in. All right. Well, let's just quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Rupal Agarwal of Bernstein will join in to discuss the global trade setup. Our research team will get you CNBC-TV18's list of top 10 stocks for the day. And 8:30 this morning, we have Gurmeet Chadda of Complete Circle Consultants joining in with a quick check on fundamentals and stocks that he likes.
On the equities then, Chris Wood of Jefferies says some changes will be made in the Asia ex-Japan and India long-only portfolio. The investment in JD.com will be removed and replaced by an investment in Baidu, while the investment in Zomato in the India long-only portfolio will be increased by 1 percentage point by shaving the investment in ONGC.
Okay, now this is Sanjeev Prasad of Kotak Institutional Equities who says that they struggle to find ideas in consumption, investment and outsourcing sectors after the sharp run-up in several of their favored sectors and stocks in the past 2 months. He says the BFSI sector is the only one that offers value, although even insurance stocks have rallied in the past few days. He says they've reduced their weight in certain consumer stocks after their strong recent performance of Britannia, Godrej Consumer and Titan. They're also trimming positions in banks and NBFCs and Interglobe Aviation to recommend large caps.
Let's get you some money market views then. Lakshmanan V of Federal Bank says throughout this week, the rupee has traded in a very narrow range around 82 against the dollar as volatility continues to remain subdued. He says the US has released a string of robust economic data, including a notable increase in US GDP, while the new home sales reached their highest level in a year. He adds that these data points align with the hawkish remarks made by Fed Chair Powell in Madrid, suggesting the likelihood of at least 2 more interest rate hikes, consequently bolstering the US dollar. Thus, he expects the USD INR to trade in a range of 81.68 to 82.35 against the dollar during the next few trading sessions.
Okay, on bonds, we have Lakshmanan V who says that domestic 10-year benchmark bond yield rates continue to stick to a very narrow range of 7 to 7.1%. He says near-term triggers are few and markets will be awaiting fresh cues in the form of US payrolls and inflation data early next month. He adds hawkish comments from Fed Chair Powell and robust data will keep the 10-year bond yield tilted higher for the next few sessions. Okay, Rupal Agarwal is joining us, senior research analyst, quantitative strategy at Bernstein. Rupal, good to have you with us here as always. Thanks very much. We seem to be in the grip of pretty strong momentum, and momentum can do crazy things. What's the call? I mean, purely from a quant perspective, are markets headed higher globally?
I mean, we are actually taking a relatively stronger, call on momentum. We do think that, this disconnect in terms of macro that we are seeing on Asia improving actually, and US or most of the developed markets still showing at least a slowdown, tends to set up a good environment to chase momentum, at least on the Asia side. I think on US, we're still relatively more defensively positioned. We do think that some of this extreme rally that we've seen, especially on the longer duration growth stocks, in anticipation of a rate cut in the last few months, I think some of that will have to be repriced in.
Rupal, so you're saying it's wise to chase momentum in Asia. So where is the momentum in Asia? I remember in the last conversation, you were anticipating a rebound in China. That really hasn't materialized. There's also a lot of fatigue setting in that when are we going to get that stimulus out of China? So the question is broadly on Asia, where is the momentum and where does India stack up?
So I think where is momentum? I think most of the momentum has actually been happening on the Korea and Taiwan equities, largely driven by a lot of geopolitical support as well as, this entire theme of AI picking up a lot of steam in recent time periods. India also is now looking reasonably well positioned from a momentum perspective. I do agree that China has not recovered to the extent that we have been hoping for, but we've still not given up hope. And in fact, in the recent call, we have again reiterated that we do think that we are again, not too far away from a potential rebound. In fact, this month has been reasonably fine, I would say, for China. And in fact, what type of stocks one needs to look for is actually a better way to look at Chinese equities going from here. So it's rather than taking a broad-based market level call, I think there are always parts of the market that have been doing well even in the last 3 years, and that's how we are approaching China even going forward.
Hi Rupal, good morning. The last few months have been very, very good for global equities on the whole. So everyone's asking what to buy, but I think the more pertinent question could be what to sell, what to avoid. Tell us, according to you, what should be avoided at these levels?
I think it really depends in terms of what markets you are looking at. So if I talk about India, I would say that there has been this very strong high beta trade that has been doing very well for almost 3 years. That also aligns with value stocks doing very well for almost 3 years now. Whereas the opposite side of this anti-value, or I would say more quality names, low beta names have been underperforming. So I do think that some of that extreme dispersion is creating an interesting environment to actually take off some profit, from the high beta trade, as well as I would say some of the value stocks. So that is where I would start, taking up some profit, especially in India. If you look at some of the other markets, again, the dynamics is completely opposite, in China. So I would say it's a complete opposite trade. We start taking off profits on the low beta side and actually start adding on high beta. So it's a very different setup in terms of which markets we are looking at.
Rupal, we'll leave it there. Thank you very much for joining us. Great speaking with you. It's always a pleasure having you here on CNBC TV18. Rupal Agarwal of Bernstein on the quant side. We'll take a very quick commercial break here, but up next, our list of top stocks to watch for the day with our research team coming up in just a bit.
record as a bank MD. When he joined Bank of Baroda as MD in the last quarter of FY20, Jan 2020 actually, the stock price was around 90 rupees. Today, as Chadha ends his term, the price is 190 rupees. In FY20, the bank had managed to eke out a profit of just 546 crore rupees. In Chadha's last year, FY23, the profit is 14,110 crore. The gross NPA then in FY20 was 9.4%, FY23 3.79%. Net NPA then was 3.13%, latest year 0.89%. Credit cost then 1.82%, now 0.4%. Sanjeev Chadha took over when the financial merger of Vijaya and Dena Banks into BOB had just been completed, but he had to see through the integration of personnel and extract synergies. Chadha was also taking over from P.S. Jayakumar, who was the only instance of a private sector banker to become the MD of a PSU bank. In the 2 terms of Jayakumar and Chadha, Bank of Baroda has been noticed for accelerated digitization of services and for a lot else. To discuss how Bob has transformed in the past few years, I have with me the man himself, Sanjeev Chadha, Managing Director and CEO. Good morning, Mr. Chadha. Thank you very much for joining me. Well, actually, that is the first question.
Welcome back. Let's drill it down to the top stocks you need to watch this Friday morning. Our team is with us, and let's start with Surbhi. There appears to be some relief in store for asset management companies. Surbhi, what were the key takeaways from the SEBI board meet on Wednesday, very late in the night?
Good morning, Rima. So that's right. Some key takeaways coming in from the SEBI board meet. The chairperson said the issue around the mutual fund TER, which is the total expense ratio, was discussed in depth, and the SEBI will publish a new consulting paper on the TER regulations. The new consultation paper will be drafted taking into consideration after all the data that was shared by the mutual fund industry players. Now, the old TER proposal will undergo a significant change, and the mutual fund industry will be pleased to see the new changes, the chairperson said. So, some positive news coming in for the AMC companies.
Okay, well, Surbhi, thanks very much for that, and we'll keep track of those companies. Stocks will be in focus. We, by the way, have the MD and CEO of Aditya Birla Sun Life Asset Management Company, A. Balasubramaniam, joining us in just a bit with some perspective. Well, let's focus on BPCL now, as Sonal is standing by with news here. Sonal, morning.
Good morning, Prashant. Well, BPCL has announced, or the board has approved a fundraise via rights issue to the tune of 18,000 crore rupees. The terms of right issue, the details, the pricing and the record date is something that they will be discussing later. But remember, they did indicate that the fundraise will be for energy transition, for their net zero goals and more investments in the new energy space as well. And do remember, in this budget itself, the government had spoken about how they will invest in all these oil marketing companies in order to ensure that they do this new energy transition as well. So it looks like the other OMCs will also be in focus on the back of this. However, Morgan Stanley says that BPCL's capital infusion via a rights issue could have been avoided, and this also highlights a shift in government focus away from divestment towards energy security. So not very impressed with this one, but it'll be interesting to see what happens to the entire OMC space on the back of this update.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Nimesh here. Told us, a few days ago that watch out for a large trade on TD Power, and that's going to happen in the next within the next 1 hour. Nimesh, tell us more.
Hi, Nigel. 25% of the company's equities on the block. We're seeing every day something new, and this is something new as well. All the 3 categories of promoters are looking to sell stakes. So the book was launched last evening. The floor price is 214, which means a 4% discount to the last trading price. But my understanding is the block will happen in the block window. The demand is strong. So despite a 25% stake sale from the promoters, I'll go with the green. That speaks for the sentiment in the market as well. I mean, it's raining blocks, and that's been the case for today as well. So I'm sure there are a couple of more blocks, but this will be a large block to watch out for. 800 crores will get raised by the existing promoters.
Okay, thank you very much for that. The promoters checking out 24% on the block, but there is a lot of appetite for that. Let me quickly talk about Tata Communications, because the company has made a large acquisition. They will be acquiring a US-based CPaaS company. CPaaS stands for Communication Platform as a Service. The name of the company is Kailera. The acquisition will be done for $100 million in cash, but the company will take on debt of nearly $150 million, which means the total enterprise value of the acquisition stands at $250 million. Now, this is a company, as I said, which provides CPaaS services, so helps in messaging, video, notification, email, voice services. They get more than 50% of their revenues from the United States. It will provide a revenue boost because the acquired company had revenues of more than $330 million last year. So it will help the company achieve its aspiration of doubling the data revenue in the next 3 years. But the only downside is that the acquired company's margins are on the lower side. So the margins are actually just at 5%. If you adjust for the ESOP, etc., costs, then the adjusted margins are close to about 5%, and this is much lower than the company's guidance of 23 to 25%. Good acquisition, reasonable valuation. It provides a fair amount of top line, but it will be margin dilutive. TREI also released the subscriber data for the month of April. The key takeaway is Bharti subscriber addition has been muted. Vodafone Idea subscriber base has declined by a massive 30 lakh on a month-on-month basis. while Jio has added about 30 lakh, making it the 14th consecutive month of subscriber addition for Reliance Jio. So keep your eye on these telecom names.
Okay, all right. Thanks a lot for that, Rima. Well, Vivek joins us to tell us about HDFC Bank as well as Credit Access Grameen that he is tracking. Morning, Vivek.
Well, good morning. Let's start with Credit Access Grameen first. We are expecting quite a large block in this particular name as well. What we understand from our sources is that, the promoter entity Credit Access India BV is looking to sell close to 5.8% stake in the company via a block deal. Now, the base price, for this particular block deal is at 1,230 rupees a share, significant discount to day first race close, and the block size is in excess of 1,100 crores. So it's a large block deal as far as Credit Access is concerned. Remember, at the end of the March quarter, the promoter entity Credit Access India held over 73.5% stake. Now, coming to HDFC Bank, remember, MSCI too had gone ahead and indicated, how they would be treating the merged entity, that is HDFC plus HDFC Bank. Now, FTSE too, in a notification late last evening, has gone ahead and said how they would be treating the merged entity within the index. So, what they will do is that they would be adding HDFC Bank in place of HDFC based on the merger terms that's already been announced. Now, this will be done on the effective date of the merger. So, net, there will not be any deletion. However, what analysts feel, and IIF Alternative Research actually mentions that the subsequent review, that is the likely September review, may see an increased weightage of HDFC Bank within the FTSE indices, and HDFC Bank may end up seeing inflows of close to $900 million. That would come as a bit of a relief, as MSCI's weightage had actually indicated a slight outflow for the merged entity.
Okay, thanks very much for that, Vivek. Well, more stocks with news flow. Surabhi is here with that list. Surabhi, morning.
Morning. So I have a few stocks on my radar. The first one is MCX. Now they've decided to extend services with 63 Moon Technologies for another 6 months yet again. Now this is the second consecutive extension that has happened. Now for this extension, they will be paying 125 crores per quarter as opposed to 81 crores that they paid in Q4 and 66 crores that they paid in Q3. So significantly higher tech costs are anticipated in the next 2 quarters. So we'll see how that works out for MCX. For ICICI Securities, the board has approved the draft scheme of arrangement for delisting of their shares, where the shareholders of ICICI Securities will get 67 shares of ICICI Bank for every 100 shares held. Now, the scheme is subject to obviously the regulatory approvals, and post delisting, ICICI Securities will be a wholly owned subsidiary of the bank. At current market price, this is a 2% premium to ICICI shareholders. And lastly on my radar is AU Small Finance Bank. The board has approved a fundraising of 11,000 crores, of which 5,000 crores will be via equity and 6,000 crores will be via debt instruments.
All right, Surabhi, thanks a lot for that. Well, here's a quick recap of all the stocks we're tracking. Stocks with positive news flow include the asset management companies. You have Tata Communications, TD Power Systems, HDFC, ICICI Sec, AU Small Finance Bank, while stocks with negative news flow include the likes of BPCL, Credit Access Grameen, and MCX, while telecom stocks as well could be looked at with a neutral view.
Okay, well, we'll take a quick commercial break here. We have Gurmeet Chadda of Complete Circle Consultants joining us on the other side for a fundamental check. Later, we'll connect with A. Balasubramanian of Aditya Birla Sun Life Asset Management Company to talk about the potential relief on the total expense ratio proposals which were put out in the consultation paper by SEBI earlier. The SEBI chairperson hinting at that. Stay tuned.
Briefly, what are the 2 or 3 things, or maybe 5 things, that has changed in BOB over the last 5 years?
So I think for any transformation, first there needs to be an opportunity, and then there needs to be an agenda. So I think the opportunity was there because, as you mentioned, Mr. Jayakumar had really come in and brought a lot of change, and initiating change is always tough. The second was that there was a merger which was underway, and it is only times of transformation where then you can really give it momentum. Third, I believe, was COVID, which was a watershed, which had also allowed you to do things which otherwise would have been more difficult.
What did you observe over the 5 years as different?
So I think 4 or 5 things. One was, of course, the fact that coming from SBI. I think the central challenge was how do you make sure that you can get talent, because if there was one thing which was different, it was SBI of course has a great model, homegrown talent, but what could you do in BOB? And I think it was a very pleasant surprise that that Mr. Jayakumar had initiated that change. We were getting people from outside, and as you progressed, you found that it was actually possible to get first-rate talent bank and to retain that. So I think that was the first element of transformation which was there. The second was technology, which was very important. Now we had made investments in technology, for instance, through a data lake, but ultimately it's important that technology gives you results, it touches the customer. And there with COVID, there was an opportunity to actually bring about a very wholesale transformation. That's where Bob World came in. Third was, I think, a performance culture, which is very important. And that's something that we were able to build. Now, if you talk to any of our people and ask them about how their branch, how their zone, how their region is doing, people have again the important performance metrics even at 3 o'clock in the night if you were to give them a call, right? Okay. And the fourth I think is important is again a governance agenda and a strong sense of ethics. We brought in Dr. Mukund Rajan to help us again construct a ethics agenda for the bank, because that is something that really is the bedrock of change that can be sustained. So I think these are 4 or 5 things which
Welcome back. Hope you're having a good morning. Well, we ran you through all the top stocks that we're tracking, but there are some brokerage notes as well that are come in. And Abhishek joins us to tell us exactly that. Abhishek, over to you.
Well, Nigel, to begin with, Morgan Stanley has written on MCX. They have an underweight trading and a target price of 1125 per share. They say that the MCX transition of technology platform to TCS is delayed, and this extension of its contract with 63 moons could actually wipe out most of its FY24 profits. So Morgan Stanley has written on Indigo, overweight rating and target price has been increased to about 3,321 per share. They say that the industry is moving from recovery to expansion phase, and that is why Indigo, with its dominant share, strong operational performance and capacity additions, is well placed to benefit from this movement seen in the industry. Now we have a couple of brokerages who have gone or cut rating on Voltas and have gone negative on the stock. So Kotak Securities has a sell rating with a target price which is cut down to 710 per share. They have cut FY24 EPS by 8% to factor the summer season, which has been a washout, especially in the room AC, and they have also cut FY25 EPS by 9% to reflect continued weak, intense competition and margin pressure amongst the fact that looming capacity addition for Voltas. We also have Jefferies, who have a buy rating but have cut their target price to 950 per share from 1090 that they had earlier. Q1 between unseasonal rains in different parts of India is relatively a weak quarter, what they have mentioned, and they have lowered FY24 cooling segment revenue growth to about 12% from 23% that they had earlier estimated, and hence FY24 to 25 their EPS is lowered anywhere between 10% to 13%. Back to you.
Okay, thank you very much for that. Let's invite Gurmeet Chadha, Managing Partner and CIO at Complete Circle, on the show now. Gurmeet, I want to start talking about TD Power. We are likely to see a very large deal. The promoters hold about 58% stake, and they're looking to sell about 24-25%. Nimesh tells us the appetite, the demand is going to be strong, so it will be lapped up, this 800 crore block deal. But how should a shareholder read this development about promoters looking to pare their stake?
So there are two aspects. One aspect is if promoter is, selling in a lot of space just to cash out, and the other option is where where the stake is being sold for some kind of deleveraging or capex plans. I think probably have to read it through more, but I'm in general very constructive on power. I think we are in a very good capex cycle. And as you rightly mentioned, there is strong demand for the deal. Also, there are a lot of ancillaries which probably, if you go to the sector, I think both energy and utilities, we are constructive. And there are a lot of, the ecosystem you can play. So APAR is one you can play on. In the power ones, we don't actually have TD Power in our investment universe, but we have not exactly related something like Tata Power, where we are very constructive, very integrated player. traditional renewable energy portfolio mix changing. Management has given clear guidance for 2025 and 2030 on how big the portfolio they want to be. Tata Power hasn't really participated the way, the way the broader markets have run up. And they're doing very good on both solar panels as well as EV charging system. And the group continuously demonstrates the turnaround in so many businesses now, which we have seen. So we are more constructive there, and we are tracking our power right now more as a proxy play to how the power capex plays out.
Oh, interesting. All right. Hi, Gurmeet. Good morning. Gurmeet, what about MCX? You know, they made this announcement a couple of years back. We are going to move on to better things. They're going to use the TCS software. The market has been waiting for that. And in fact, has been pricing that in. That's why the stock has run up a goodish bit. Now it's trading at the upper end of, the 20s, the late 20s on a PE basis. But now they've renewed that contract 125 crores per quarter with 63 moons. 63 moons is release was quite interesting, right? I mean, they said, you're trying to move on from me, but you seem to have some left. I mean, you have to bear with me for 6 more months at least. How do you approach the stock? It's going to get clocked back today.
Oh, a very negative development indeed. So if you add that up, it actually wipes up almost the entire EBITDA for this year, right? And there was an expectation, and that's why there was a build-up that they would eventually move to the new TCS platform. So any such news where, and as you rightly mentioned, the outlay is 4 billion with almost 400 crores. I think that will almost have the entire impact of, I think the projection was about 450, 500 crore kind of an EBITDA for this year. But I think sometimes, these things are beyond your control. So we do not have, MCX in the universe, Nigel, but clearly a negative development.
I think Motilal Oswal has cut their EPS estimates by nearly 60 to 70%, as this technology extension with MCX will pretty much wipe out its FY24 profitability. Gurmeet, do stay on. We want to touch upon another very important development that happened 2 days ago. Market regulator SEBI cleared an array of proposals at its board meeting, which was held on Wednesday late evening. These include halving IPO listing time to 3 days from 6 days at present. The board also approved making additional disclosures mandatory for certain FPIs. SEBI chairperson Madhvi Puri Buch in her press conference said that the issues around mutual fund TER regulations were discussed extensively in the meeting. Listen in to what she had to say.
Proposal was discussed in depth, and the board finally advised SEBI to go back and publish it as another consultation paper. Reason being that, as I had mentioned earlier in some forum, that unlike our normal proposals which are done by way of co-creation with the industry, since this was a price-sensitive subject, we did it with the limited data that we had and without the benefit of the data that the industry had. So once our consultation paper was there, then naturally industry came back with their granular data. Now when we saw that granular data and said, okay, we now understand this, so therefore a lot of the things that we had built into and baked into our original proposal needed to undergo a change. We modified the proposal, and the proposal was actually, I think the industry would be quite pleased to see the new proposal. And therefore what the board said was, look, the proposal has undergone significant change because, as we described, we had more data, new data, and therefore we obviously, as I've always said, that the data will speak. So our policies will always rely on data. And therefore the board advised us that publish your new proposal, which you have put to the board, publish it again to the industry, and let us see now with this fresh proposal, which is quite different, let's see what the feedback is.
That's in response to the question from our colleague Yash Jain, basically clarifying that a new consultation paper will be put out and then we will decide. Well, A. Balasubramaniam is Managing Director and CEO at Aditya Birla Sun Life Asset Management Company. Bala, good morning. Great to have you with us here. This must be music to your ears, not just yours, but other mutual fund CEOs as well. What do you make of it, prima facie?
I think, first of all, glad, Prashant, that SEBI chairperson has acknowledged the data that was provided by the industry while giving input to the SEBI chairperson and the whole team. And also mentioning about the data that the mutual fund industry presented, the more granular data had more insight, which essentially reflects the goodness of the industry in terms of having a data in every possible way that actually helps into making a decision. And that's something we are quite glad. I still remember, thanks to a SEBI chairperson who gave us an audience to meet some of us to make this representation. And they did give us the guidance in terms of how we should go about analyzing the data. And as we got into more data analytics, how the industry scale benefit has actually accrued to benefit, one, the industry to grow, second, industry to expand the customer base, and third, giving the product at a relatively lower cost, yet give us a good experience with investors. All those things came out very clearly in that, and we are pretty glad and happy that SEBI took this decision of acknowledging in one first the industry representation, and second, having realized that there is a need to revisit the earlier proposals itself, in my view, is the good news both for the industry as well as the SEBI's acknowledgement as well.
Mr. Bala, Rima here. Two questions. One, could you give us details about the granular detail which was shared by the mutual fund industry? Two, and what would be the TER which will make the mutual fund industry happy? Because she explicitly said, right, the second set of proposals might make the mutual fund industry quite pleased or happy. So what would that number stand at, according to you, or should stand at?
See, what is the premise on which the whole discussion of tier reduction came into place? I think the last change that happened in the year 2018 and 2019, and since then the industry has grown from about 12 lakh crore to about 40 lakh crore size. So there was a discussion on that as industry size is becoming bigger, the benefit of scale should accrue to the investors. That is the first premise on which it was being done. This is one of the data that we of course did present. In the same 2019, there was a glide path that was given linking to the individual scheme size. As the scheme size become bigger and bigger, the expense gets automatically reduced. So therefore, the investors get the scale benefit. And the assumption that was also being made, scale benefits also is accruing significantly to the profit. But I think if one deep dives into the AMC industry, the profit margins are not going in along with the industry increase in size. Profit, absolute margins, the basis points have been coming down, but absolute profits have been going up given the fact that people have been building a scale. That's the way the industry model works. So also being highlighted as one of the points. And third, of course, the point is when you make single TER, taking into account all the statutory obligation that all of us have got, if they also get included in the overall the TER structures, definitely the impact of that in terms of the final TER that could come, and therefore the impact of that and the profitability and the cost of operations and so on and so forth could get impacted. And especially SEBI chairperson did mention about arbitrage fund as a category, which has got trades that happens every year, 12 times in a year the trade happens, buy and sell happens. If all costs get added to the TER, naturally the product will become unviable, and it can also do harm, one, to the growth, and second, it can do harm to the market liquidity as well. So that's the way the representations are made, and which we felt that it was appreciated, acknowledged itself, in my view, is the proof of the transparency that industry has built over a period of time.
All right. Good morning, Mr. Bala. Nigel on this side. Well, it's good, right? The SEBI has taken the industry feedback on board, and we'll wait for the finalization in terms of a rational TER. But what has been your feedback from distributors who will get directly impacted? Do you fear that they'll shift to PMS, AIFs, or maybe move to insurance? What's the feedback you've got?
In fact, this time the distributors also had given a feedback, which is basically FIFA is one of the largest industry representative on the distribution side. FIFA as a team have given their input, more or less in line which what AMC have also given the fact that mutual fund will remain the core portfolio of every investors. Therefore, MFDs will continue to keep mutual fund at the heart, and rest of the other products will be more tactical kind of product, in order to discourage people move from one product to other product, any significant reduction, as you rightly put it, could actually lead to a shift from a mutual fund to the AIF and other asset classes, which not generally the way in which MFDs operate, because they keep mutual fund as the core and the rest of the product comes an ancillary, taking into account the interest of investors. So they did make a representation of this. And second is, even when we made a representation, any significant reductions could also lead to the expansion. What was said and done today, the mutual fund industries works for not just AMC alone, it's for the whole ecosystem. When I mean ecosystem, it covers distribution expansion, it covers geographical expansion, having a presence in every nook and corner of the country, and third, the customer expansion, both at the retail level as well as on the MHNI and HNIs level. So that's also something which was highlighted both by the industry associations, mutual fund side, as well as the FIFA as an association.
Okay. By the way, Bala, are you expecting the consultation paper soon? The new one? It'll follow the same process, right? A consultation paper and then a decision.
See, one good thing always, we as an AMC industry have the blessing of regulators is always in the form of a consultation, and the decisions are always
so we should expect a consultation paper, right? Now, a new one.
Yes, exactly. As the chairperson has mentioned about it, yeah.
Got it. Bala, thank you very much. We're just a little tight on time, but great that we could speak with you. And thank you for joining us here on CNBC TV18 with that. So that is certainly positive for asset management companies. The degree of how positive it is, of course, I mean, we'll only know when the consultation paper, the new proposals are published by SEBI, but mutual fund CEOs will be pleased. We'll slip into a break here. Anuj will be with us with a quick trade setup. Post that, our top stocks for the day. Our technical and F&O experts also join in. Stay with us.
Take each of them in detail. One thing you didn't mention, and which other Bank of Baroda, old-timers told me, is that you've also introduced, or maybe with Jaykumar, I don't know, a collection mentality. I mean, until very recently, growing the balance sheet used to be the goal, but you gave a lot of stress to collection.
So I think it was really identifying that what were the missing pieces, right? And one of the missing pieces was, if you were to look at what is it that, where are we away from the best? One was in terms of growth rate. Public sector banks have been losing market share. The second was in terms of margins, right? They are lower, which are as compared to others. Third was in terms of, again, the asset quality. Right. Part of the asset quality is, of course, cyclical, and we have seen some of the upside from there. But fundamentally, if you want a sustainable transformation, it is the collection mechanism which needs to change. And what we found was, as compared to some of our competing banks in the private sector, the kind of resources that you deploy for collections, again, were suboptimal. And also, again, it was as a discipline not developed. So among the people that we brought in, we also brought in, again, a head of collections from a private sector bank who had been doing it for 20 years, built a large team. And particularly now, as we go into areas like unsecured personal loans, you go in for new to bank customers, I think it's very important that a collection machinery actually precedes, again, going aggressively into any business rather than succeeding that.
The other thing that clearly has succeeded, and you alluded to it a couple of times, the ability to integrate lateral recruits. I mean, now even the government is advertising for joint secretary level lateral entrance, but that's a new thing. That it has succeeded so much is a surprise.
So in some ways, you always try to do different things and see what works. So.
Okay, welcome back. There's 14 minutes to go for the market open, the pre-open, and SGX on your screen, 19,176, indicating a big start higher as compared to the previous close. Anuj is here with how he's seeing things. Anuj, good morning.
Good morning, Prashant. You know what? It took 21 months for us to move from 18,000 to 19,000. I won't be surprised if in 21 days now we hit 20,000. I think the market's got that kind of momentum with it. The July series starting, of course, with slightly higher open interest than the June series, about 91 lakh shares versus 87 lakh at the start of June series. And the market-wide open interest is also higher because of the kind of rally that we have seen in the broader market. The mid-cap index was up 7% in the June series. The big Q to watch, of course, will be earnings, especially in IT, because we all know domestic earnings will be strong, but can IT be a bit of a dark horse? That's something to watch out for. Now on the Nifty, it's a bit tricky because you've had 2 days of rally and there's a gap up today. And normally third day is the one in which you normally see some profit taking. So the first support level is the erstwhile resistance, which is 18,875 to 18,925. And the bigger support zone is 18,750 to 18,850. I think what traders need to do perhaps is wait for any kind of intraday dip perhaps to add and put some kind of stop loss, perhaps the last high. On the Bank Nifty, which has underperformed in the June series, it started to show signs of coming out of that over the last 2 days, especially led by HDFC Bank, which is the one which has really taken over the leadership position now. And again, this is an index where every dip should be used to buy because HDFC Bank is continuing its leadership. And 2 other stocks, ICICI Bank and SBI, they have also started to show some signs of bottom. Axis Bank came to 20-day moving average and bounced back. So the signs are there that perhaps the Bank Nifty can lead the next round of move on the Nifty after underperforming in the June series.
Anu, just a point on IT and the fundamentals. The downgrades which came on IT post the Q4 earnings, right? Once that was factored in, the first half is going to be weak. Were that the second half recovery will not take place. The second half recovery is going to be elusive. But looking at the US economic data, yesterday, all the 23 big banks passed the stress test. The data has been strong. So there is a possibility that, the strong economic data, the clients which were cautious in February, March, April, May not be so cautious, and the recovery, as the companies were anticipating, actually plays out in the second half.
I think you hit the nail on the head, and perhaps that's what the market's trying to preempt over the last few days. If you see, stocks like HCL Tech, for example, recently hit 52-week high. And HCL Tech this time actually is taking the lead and is announcing the numbers on 12th. Yeah. I think in that sense, I think the stars are aligned for a rally in IT as well, but let's see how the market moves.
So Q1 will be muted. The question is really about, but it's priced in. The question is about the second half and the recovery. But let's get in a few more trading ideas. Mitesh Thakkar, Shrikant Chauhan of Kotak Securities are with us now. Mitesh, looks like it's going to be another bumper opening closer to the 19,200 mark. That's what the SGX 50 is suggesting. Of course, in the cash rate, it could be a start higher by close to 100 points. Any trade at the index level?
On the index, we have been maintaining long positions, and adding a fresh is something which I'm not very sure about. Very clearly, I think, after a rally which started from 18,650, buying at 19,200 may not be the best idea. But I think, what we will do is post the opening, we'll look at a very quick, training of the stop loss kind of a thing. And then we'll see if the market doesn't see any signs of weakness, then maybe a fresh trade with gap, with the gap of opening, which happens with gap as the stop loss, can be taken. But otherwise, I think for the time being, my initial reaction is to trail my stop loss and see how the market reacts after a good rally, which has panned out for about last 5-6 months.
Gentlemen, good morning. Shrikant, what about you? How would you look at things?
Yeah, good morning, Prashant. I think, now the markets are into blue sky zone, and whenever there is such type of scenario, we measure the targets based on extensions. So based on the overall formation, we are expecting now the Nifty to move towards 19,350 and Bank Nifty somewhere close to 45,300, 350. The strategy should be to look for adding position if there is any correction. See, today, because of Singapore Nifty, which is showing some 200 points rally, it is better to chase stocks instead of chasing index. But if there is any correction because of any reason, because the market can correct any time whenever there is a gap of opening. So it comes down to fill the gap. If there is any correction, then close to 18,950, we should be buyer on indexes.
Okay, all right. Hi, good morning, gentlemen. Shrikant, you go first. What are the picks you have for us?
Good morning, Nigel. I think the way there is like a specific news flow for the bank stocks from S&P 500 and Dow Jones, I think tech stocks should do well. And in that, we like HCL Technologies, which is currently trading around 1170, 1180. So from here, the stock can move to 1230, 1240. At current level, it's a buy with a stop loss at 1140 on the downside. The other stock which we like is HDFC Life, and it is forming higher top, higher bottom series. So the next level to watch out for would be 690, 695. Here also we have a buy call and with a stop loss at 640 on the downside. And the other stock which we like is from the auto space. Ashok Leyland is really doing well. It is forming some continuation formation. So the next level on the stock based on extension is somewhere close to 172. It's a great risk-reward ratio to buy at current levels with a stop loss close to 164.
Okay. Mitesh, what about you? What would you trade in terms of specific stocks?
Morning, Prashant. I have all buy calls. Bajaj Auto is the first stock on the list. Buy here with a stop at 46.70 for targets of 4800. Indian Hotel is a buy with a stop at 390 for targets of 410. A buy on Chola Finance, which I would recommend buying with a stop below 1100 for targets of 1190. And Polycab is the final buy call. Keep a stop below 35 to 75. Look for 3700 plus as your target.
Okay. Well, gentlemen, we'll come back to both of you in just a bit. Mitesh and Srikanth, appreciate you joining in with that. Manoj Muralidharan is Vice President, Derivatives at Religare Broking. He's joining us to take some questions. Manoj, good to have you with us here. Good morning. In the grips of some pretty strong upward momentum, Manoj, what is the data telling you and what would you recommend?
Good morning, Prashant. Prashant, the simple way to look into the market is the strength with which a series starts. So when we started the June series, the Nifty positions were almost 87 lakhs, and now we are almost a good 3.5 lakhs more, almost 91.5 lakhs. Same goes with the Bank Nifty. The Bank Nifty was almost 20.5 lakhs in June series when we started new, and now we are at 22 odd lakhs. Now, a simple way to understand derivatives is obviously when there is momentum in any trend, we see the positioning going up. Even the market-wide position, market-wide is your entire stock futures along with the index futures that you have for this series and the series going ahead. So that also is at almost 2 to 2.5 million more. It was a 48 odd million. Now it is almost at 51 million. Simply saying that FIS shorting, which was there in the last month, was rather the long position was just at somewhere close to 57. Now we are almost at 61 to 65. So we are seeing good long formation in all the series along with certain sectors, and all of this has happened without the Bank Nifty really participating in the last 8 to 12 odd session. Now that the Bank Nifty has come back, we believe that the positionally 18,800 as a pivot or as a support, the Nifty has a potential of almost 19,300 to 400 for this series, thanks to the VIX, which is almost at 10 to 11%. So that is what it proclaims. Intraday, a dip of 19,000 to 19,040 should be a good level to go long because this was a truncated week. We'll have the weekend selling also coming in. So try to use an at the money option, which is 19,000 strike for a target of somewhere close to 19,150 to 180 on the Nifty futures.
Okay, what would you trade in terms of individual names? What would the calls be, Manoj?
Prashant, sector-wise, pharma, at least in the last 4 to 5 sessions, I've seen good amount of money in terms of delivery buying along with the positional activity that we are seeing in the derivative side. So we like Sun Pharma and we believe that 1060 to 1070 can be a target. Try to initiate the call between 1010 to 1020. That's the closing price. The stop loss here should be 990. And again, from the autos, we believe Bajaj Auto had seen a stellar rally in the last 1 hour of session along with the long positioning. So we believe the follow-up buying can come in, and the target would be somewhere close to 4760. 4710 is where we recommend buying that. The stop loss should be somewhere close to 4680 on the stop.
Manoj, thank you very much for joining in. We need to slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Pinakin Parekh of JP Morgan India to talk about the trends in the metals, cement, oil marketing companies and his preferred picks.
Are not native to public sector banks, right? They are disciplines which again we have not really developed as well. And the question is, how do you actually acquire those businesses? How do you build those businesses? One way is to get a consultant and help you do it. But what we found was it was a far better idea and something that works far better if you bring in somebody, but somebody at the top, because it means that you bring in experience. You also bring in the ability to attract a team around that person who's building that business. And that's something that becomes a sustainable business model.
But won't you disturb the salary hierarchy?
So I think the fact is that the third pillar that I mentioned, performance culture, once you build that performance culture where everybody believes that, look, they do need to perform, there is no option, then people actually start coming to you themselves and saying, look, this is a gap that is there in my capability. Why can't we get somebody from outside to fill that capability gap?
Okay. Oh, that's good if lateral recruits have integrated so well. I'll come to these long-standing issues in a bit because the stock market will also want to hear from you the more immediate performance targets. One, your NIMs. as I said in the beginning, it's a superb improvement. I think it's the best in many years. But is 3.5 or 3.6 maintainable?
So I think there are some structural factors which are at play, which I believe should help us bring about improvement as we go along. There's no doubt that we again at a very fortuitous point in the cycle. But for us, for instance, again, you will find that it is the retail loan growth which has driven growth. So last year, overall growth was something like 17-18% in loans, but the retail growth was 27-28%. And that is something which is significantly margin accretive, in the current context, because corporate loans, again, margins have been under pressure for the last few years. And number two, also again, because these loans tend to get repriced based upon how the interest rates move. So if we are able to bring the proportion of retail loans progressively up by 2 or 3 percentage points each year, I think this will have a salutary impact on margins as we go along. So that's that.
Welcome back. You're tuned into Bazaar Morning Call, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, it's that time of the day when we get you a momentumizer of the day, and Manglam joins us to run us through a stock that he's picked. Morning, Manglam.
Good morning. So I'm looking at JBM Auto. There was a big move on Wednesday on the stock. It was up almost 13% and with huge volumes as well, nearly 4 times the average traded volumes on that stock. Then I dug deep and I realized that, it's not just Wednesday. This week itself, the stock is up around 21%, and this year it's up 51% as well. And then late last evening, we did get a notification from the exchanges saying that the promoter Nishant Arya has infused funds in their EV subsidiary, EV bus subsidiary, which is JBM Eco Life Mobility Private Limited. And for that, they've been allotted about 17% equity. So as a result of which, the wholly owned subsidiary has now become just a subsidiary with 83% stake owned by JBM Auto and 17% owned by the promoter Nishant Arya itself. And why is this bus subsidiary extremely important for the company? Because the last time we quizzed them, they said that they are looking at some sort of fundraising in the bus business. At the same time, the bus revenue, they target a 3 times growth in FY24 itself, with volumes actually increasing 10 times. They delivered 500 buses in the previous fiscal. This year, they are targeting 5,000 buses itself. The only thing that we don't know, the price at which the allotment was made to the promoter. So that's something that we need to find out.
Okay, all right. Manglam, thanks a lot for that. Well, the stock has seen a big surge as well. Gurmeet, any view on JBM Auto?
Nigel, we have it in our universe, but we are not invested here. We'll probably track the CB news closely. What we like is Minda. We have discussed that various times, which is Uno Minda. Another one which we are now tracking is Sandhar Technologies, because that's a main, it's a proxy way to play the recovery in two-wheelers now. So they are one of the main content, additions to TVS. Now they've added HMSI also. And their kit value is growing consistently. So in one of the few models in TVS, it's actually gone up to almost 35,000, including your locks, metal sheets, as well as die castings, etc. More prudent capital allocation this year. Probably the free cash flow generation will also will surprise positively. It's run up, but if you consider since IPO, the valuations are still like, if you do the FY24 maths, it would be like 19 times or something. So that's something we are tracking more right now vis-a-vis others.
Okay, all right. Gurmeet, I also wanted to ask you about HDFC Life. If you're opportunistic and you bought when on that budget day when the shocker came about, the stock cracked 500 rupees. Now it's set around 650 rupees, but the street was bracing for HDFC Limited to go ahead and buy the 2.5-3% stake from the open market and make it a subsidiary. That's happened. So that support has gone out now. How do you view the stock at this price around 640, 650 rupees after it's given a return of 25% in 5 months or so?
Nigel, the IPO came in the 275-290 band, went up to I think 770 or something. And then I think it's been stagnant for 2-3 years. A lot of challenges starting with COVID, high claims, and then regulatory changes. I think insurance is a very long-term secular trend. I am a personal investor since IPO. We also continue to hold it in our portfolios in PMS. I think what is now we are seeing is that now the product will be sold more on the insurance merit versus tax arbitrage and offering guaranteed returns. Also, their non-par portfolio is less interest rate sensitive vis-a-vis banks. So I think that below 5 lakhs will stabilize. I think the street overreacted because they initially thought the impact on the AP would be 15-20%, which now, if you see the trends in May, HDFC retail AP is grown 10%, and the management is actually guiding for double-digit AP growth and saying that they will be adding to the VNB margins by 3 to 4%. And I think the trigger started when Aberdeen did a block deal on the last day of May. That's when the stock started moving 3-4%, and then this HDFC news. I personally think insurance is a very stable sector. Our stock picks are HDFC and iGroup in this space.
Okay, all right. Thanks a lot, Gurmeet, for joining in and filling us in with your view on a whole host of stocks. Wishing you a good Friday ahead. Well, time to shift focus now to some sectorial calls from JP Morgan. In their report, JP Morgan says that they have a positive call on steel as they expect domestic price cut cycle to end soon likely. And they also have a bit of a cautious view on cement. While on crude, they have cut their forecast from around $80 per barrel to around $74 per barrel. Pinakin Parekh, Executive Director, Metals as well as mining, oil and gas and cement, well, joins us on the show. Hi, Pinakin. Always good to speak to you. Well, we're going to be focusing on steel, cement, as well as on oil and gas. Let's start off with steel first. You've been quite positive on it. But domestic prices, steel prices, are at a bit of a premium in comparison to imported steel. So the street is bracing for a price cut. Could you tell us what could that quantum be? Are you baking that in?
So good morning, Nigel. So we do expect a price cut in July, but our view is that we are probably at the end of the steel price cut cycle in the domestic markets. Chinese domestic HRC export prices have fallen to $550 a ton, but seem to be stabilizing at those levels for the last few weeks. And incrementally from here, news flow should improve in China. Domestically, we are at the weak point of demand given the monsoons, but underlying demand remains very strong. Historically, we have seen that in the past when domestic demand tends to be strong, domestic steel prices do tend to be at a small premium to imported prices. This is just because of the ready availability premium that is there. So overall, yes, there should be a price cut in July, but probably we are at the end of the cycle, at least for now.
What kind of a quantum we could look at?
So I haven't done the numbers, but it should be a small price cut. We are unlikely to see a very large one. So at $550, the landed prices out of China works out to around 53,000-54,000 rupees per ton.
All right. Pinakin, the other point that the street is working with is prices have been, a little bit softish in line with what's going on in the globe. But the positive is that coking coal costs have declined substantially. So raw material cost is lower, though your selling price as well is lower. What kind of spreads are you working with in comparison to Q4, say for Q1 and Q2? Give us a brief number.
Sure. So at this point of time, obviously for the steel companies, what has helped is the sharply lower coking coal price. However, there is a lead and lag. So essentially, whether it's a steel or a cement company, there tends to be a 2 to 4 month lag before the spot prices flow through to the P&L. Seasonally, 1H volumes tend to be lower than 2H. So there is a negative operating leverage which comes through. If you look at spot steel spreads, essentially spot steel prices minus iron ore and minus coking coal cost, implied spreads are broadly stable versus the March quarter at this point of time versus what the companies reported. So we haven't done the numbers, but it looks like it's a relatively healthy operating environment for the Indian steel companies versus what the markets had feared when steel prices started falling.
Okay, all right. The other problem is Chinese exports that spiked up to an annualized rate of closer to 90 million tons. That's a worry, right, when China starts exporting more. But you believe that this number will get rationalized? To what levels?
So a couple of things over here. Obviously, the Chinese net steel export surge. It went from a 4 million ton monthly run rate to around 7.5 million tons in the last 3 months. That is a clear negative. But what we need to also keep in mind is the sharply lower steel exports out of Russia and Ukraine. So to that extent, the global steel supply has not really moved as much as what the Chinese net export number will suggest. Second is on the margin, there will be some positive news flow in terms of whether it's a stimulus, whether it's a set of measures which positively impact demand. So Chinese steel exports sequentially should be lower in the second half versus what we have seen in the last 3 to 4 months. So that should also stabilize sentiment and prices.
Okay. Pinakin, hi, good morning. Thanks for joining us. So that's metals and steel for the viewers. But, you know, in order of preference, you like metals, then you like energy, and then last you like, the least liked sector is cement, and we can talk about the others as well. But just a quick word on energy and oil marketing companies in particular. You must have I just want to get your views on what BPC are proposing, which is approval for a rights issuance. What do you make of it? I mean, is this something which is going to be negative for shareholders? Is it required at this stage? Because arguably profitability has improved quite a bit.
Sure, Prashant. So we would not comment on specific companies and what their proposals are. Overall, we do believe that Indian energy companies would need to step up capex related to climate change. At this point of time, there are not many details available in terms of what are the spending plans and how do they plan to go about it.
No, but if all the oil marketing companies were to do it, would that change your view here?
So again, since we do not have any details, right, at this point of time, what we do know is that the refining environment broadly remains very supportive, especially given the arbitrage barrels that the Indian companies are sourcing. Implied marketing margins are also very strong. It allows companies to recoup the losses that they incurred last year. It should also allow net debt reduction. So at this point of time, we have visibility on the near-term earnings. Beyond the near-term, capital allocation is something where we do not have enough clarity as to how the companies will go on spending. Again, these are very long-term plans, so very difficult to say if there will be any immediate impact on this year or next year's financials.
Do you think we're likely to see a retail price cut by the oil marketing companies, especially in the run-up to the elections? And if it does come through, will it hurt?
Yeah, sure. So if you look at what the gross margins are across the sector, they are at very elevated levels. There is a historical average and the companies are running far ahead of the historical averages. So at some point of time, there will or there should be a retail price cut. In terms of timing, very difficult to say whether it is A month or B month or C month. What we like is that the companies are being allowed, or the sector is being allowed to recoup the losses that they incurred last year. But there should be a normalization of prices at some point of time in the second half of this fiscal year.
Okay, well, we'll leave it there, Pinakin. It's a pleasure having you with us here. Thank you very much for joining us. And thank you once again for being here on CNBC-TV18 this morning. Well, there's just 5 minutes to go for the market opening. I just want to quickly put up the asset management stocks for you. The HDFC AMCs of the world and the others. Nifty is indicating a 105-point uptick. HDFC AMC is up 5%. But I think that is the one which is seeing the maximum impact of the potential relief which we discussed earlier. Nippon Life is up 3/4. UTI AMC is up about 3% as well. So these are the AB Capital on your screen as well. That one has done extremely well for other reasons as well. It's got other businesses. So that is down about 0.75%. Well, Mitesh is with us with his 9-10 calls. Mitesh, good morning again. What do you have?
Morning, Prashant. I would suggest a buy on Bajaj Auto. Keep a stop at 46.70 for targets of 48.
Okay, that's the 9-10 call on individual stocks. Let's talk about MCX. In pre-open, it's currently down 10%. So it'll be a big knock is what we should expect early in the morning. But take us through the news and the impact.
So the news is now they've extended the contract with 63 Moon Technologies for another 6 months. Now this is the second extension that has happened, and this time the cost is going to be 125 crores per quarter, which is almost 54% higher than the previous one, which was 81 crores. Now this means that entire FY24 profitability will be wiped out because of this extension. They'll be paying out almost 250 crores in the first half of the fiscal to extend the services to 63 months. Obviously, the brokerages are also pretty negative. Morgan Stanley has an underweight rating with a target price of 11.25. They say the extension will wipe out most of the FY24 profitability, though FY25 forecast remains unchanged, but the uncertainty could weigh on the PE. Investec has a hold rating from previously a buy rating. They have cut down their FY24 core EBITDA estimate by 92%. And Motilal Oswal has a neutral rating with a target price of 1400, and they have cut their FY24 EPS estimates by 69%.
Okay, thank you very much for that. Going to watch for Tata Communications as well, because the company has gone ahead and acquired a US-based CPaaS company called Kailera. The cash outgo will be $100 million, but they will take on the debt of $150 million, which means the enterprise value stands at $250 million. The acquisition will boost the top line of the company. Remember, the company has an aspiration to double its data revenues. So with this acquisition, which has about $300 million plus in terms of top line, there is going to be a revenue boost, but margins will get diluted. Kailera had made an EBITDA loss last year of $15 million, and Tata Communication has an aspiration to have EBITDA margins of 23 to 25%. So there is going to be some EBITDA weakness. IIFL today has downgraded Tata Communication to a reduce with a target price of 15.18. So watch out for Tatacom. But let's get to Nimesh with the standout brokerage stock of the day.
Hi Rima, so today's standout is on delivery. Bernstein has upgraded the stock to outperform now, and they have a target price of 460. Now, the upgrade is primarily on back of their positive outlook on the overall mid-cap and small-cap space, but specifically to delivery, they see a large comfort in terms of earnings bottoming out with a positive operating cash flow in the near term. On back of that, they've raised the FY24 and FY25 earnings estimate, EBIT estimates by 25 to 60%. So after a long time, an upgrade on delivery, Bernstein has upgraded to outperform, and they have a target price of 460.
Okay, well, Nimesh, thanks very much for that. Mitesh is still with us. There's what, 2 minutes to go, less than 2 minutes to go for the market open. Mitesh, anything else coming up on your screen looking at the pre-open?
I think, I haven't really looked at the pre-open rate because I'll wait for the opening rates to come. But otherwise, I think a lot of stock breadth has been very, very positive, Prashant. I think it's that area which keeps on attracting me. I just heard you guys mention and talk about Tata Communication. I think that's on the radar as well. It's given a good pullback, and once it starts getting past 1590, 1595 levels, expect the rally to about levels of 1635 to begin with, and maybe the all-time highs can be cleared.
Okay, all right, Mitesh, we'll touch base with you in the coming hour as well to get your fresh trade as well as your call on the index. But just a few seconds actually to go before we open up on the Nifty as well as the Nifty Bank. For starters, it's looking very, very good. Yet another record high is what we're looking at. The Nifty is indicating a 105-point gap up. The Nifty Bank, well, 350 points higher. So let's see how this goes. The temptation is that, in fact, maybe we even go higher from here. But let's see about that. For the time being, the official rates are in. The Nifty opens up, gap up, or yet another record high on the Nifty. The Nifty Bank is well up, close to around 150 points. So pattern there, as the opening came in, there was some program selling that we saw both on the Nifty as well as on the Nifty Bank itself, which is a big gainer from the Nifty. Well, you have Power Grid that's up close to around 2%, Infosys as well as up close to around 1%. On the flip side, Bajaj Auto and Hindalco, both of them are losing out in trade. But the big stocks that you need to be focused on is the AMC companies. They are happy with what the SEBI chief had to say. The TER, maybe some rationalization out there. So that's why HDFC, AMC is flying away, Nippon Life India is flying away as well. And on the flip side, MCX renewed the contract with 63 Moons at 125 crores per quarter for their software, smacked down 10%. Rima.
Well, so MCX is the top F&O loser in the morning in terms of volumes and in terms of price. And the top F&O gainer today is HDFC AMC, which we spoke about. But the others include Nippon Life. That's higher by close to about 3% in trade. You've got some green on the screen when it comes to TD Power. As Vivek and Nimesh were saying, that even though the promoters want to exit, the demand is very strong, in the secondary market. So the block deal is going to get lapped up. And TD Power has opened with a gain of close to about 1.5 to 2%. On the losing side, Tata Communication has opened with a cut of 4%. This is after the company made a big acquisition of a CPaaS company. The street is worried that this acquisition is going to dilute the margins of Tata Communications. Remember, even last year's acquisition of Switch that the company did was margin dilutive, and this is further going to put pressure. Credit Access Grameen, where the promoters are looking to sell 5 to 6% stake, has opened with a cut of 2.5%. Aurobindo Pharma, there was news about a Form 483. ISEC has seen some profit booking. Earlier in the week, remember, it had rallied on news about the delisting. Yesterday was the board meeting. Share swap ratio announced, and the stock is down close to about 3.5%. Some cuts seen on Voltas, opening in the red. You've also got green on the screen when it comes to BPCL. But all in all, good opening, right? Building on the strength, 100 points higher in the cash market on the Nifty. Sensex up close to about 400 points. Advanced decline ratio is looking good. 5 stocks in the green right now, for 1 in the red.
You know, it's a crazy market, right? You've got large blocks coming, but instead of stocks opening at a big discount or anything, I mean, stocks actually open higher. You know what, it's just that kind of market.
And it's also that kind of a market where we're not talking about what's happening in Asia, right? Since morning, we've hardly, taken a check on Asia, because Indian markets have so much momentum that irrespective of what's happening in the Asian screen, it matters, of course. But it's not the sole driver.
It's 2021 again. So who cares what's happening in the US and Asia, etc. But, when you get too much on that side, one side, I mean, you got to pull back a little bit mentally. Just a couple of names, Nigel, and throw it to you. So HDFC AMC, look at that. I mean, HDFC AMC is up 9%. It's got huge volumes. I mean, it's right there on the top of the sort of board there, 2,225 on HDFC AMC, and I think there are some blocks, etc. Maybe we'll put that out. Manappuram is, the recent low was 120 around there, but it's rallied now about to 133. We've got Suzlon, which is coming up with very large volumes. It's crossed nearing 16 rupees now, actually middle of 15 and 16. Power Grid is up about 2.6. 63 Moons we mentioned. Nippon India is coming up a little bit, UTI, AMC, but those are in the 3 and 4% range, but picking up for sure. And you got Nucleus, which is up about, I think about 1.5% as well. So this is, the gainers list out there. Big volumes on Adani Transmission as well. I mean, actually huge volumes. It's a 3% cut on Adani Transmission. I think we're at about, 797 or so. On that one. Ease My Trip is another one. Credit Access is down, and I think there was that block on Credit Access as well. 3% lower, 1287, 1288 on Credit Access.
Yeah, I just wanted to point out that Adani Transmission large trade, 40 lakh shares odd have changed hands. Also keep an eye out on Suzlon. That's up close to around 5%. You have ICICI Security as well. They have come out with a buy rating, and they have a target price of around 22 rupees. So that explains why massive volumes, stock up close to around 6% odd. But Mir Bora joins us in the studio. Hi, Mir. It's a rainy morning.
Yeah, rainy but a happy morning.
Yeah, that's good. And the markets
and you made it here. So.
And the markets are making fresh all-time highs, and obviously portfolios are feeling good as well. But Mihir, what do you think about the headline index from here on? Before we discuss about various themes, given that we're at around 19,000, we could easily do another 5% from here. But do you think in the next, say, 12 to 18 months, or the upside on the headline index could be capped? Given the valuations, given that we're getting into an election year, the Fed, I'm not sure what they're going to do next. So given all of that, do you think upside on the Nifty could be capped?
It may be capped, but it's still a healthy outlook in the sense that the index has actually done nothing almost for 15-18 months, right? And earnings in the meantime have grown by 15-17%. Expectations are another 15% growth for the next couple of years. So given that we expect good earnings growth for the Nifty as a whole, and valuations are at a little above long-term averages, about 19 times on a forward basis.
Yes.
Remember in 2022, early 2022, we were trading at almost 23, 24 times on a forward basis. Now we are down to almost 19 times. So valuations have time corrected. The large indices have time corrected. Probably a little bit froth on the small cap and mid cap front, but nothing to worry about. So I would expect normal, when we say 10 to 12% kind of returns from the large cap indices.
Okay.
What are you doing, Mir? That's what we want to know. What exactly? What is the new thing you're doing? Or are you happy sitting on what you have, what you own, and that's doing just fine?
Trying to pick stocks, obviously, that's what you need to do. But in general, the broad theme that we've discussed many times, that the domestic sector is definitely doing much better than the global. Plus the government-linked segments like infrastructure, road building, railways, defense is working. I think the big call that one needs to take is what happens in China. Whether China comes up with another big stimulus, which can potentially impact metals and global growth. But apart from that, I don't see too many risk factors to the domestic theme. The exporters like IT, etc., we're still underweight. But the way US is not going into a recession, I would say, it also may be an attractive bet at some point in time. But we would wait to see the hiring numbers and some big, announcements for order wins, etc., for some of the large companies.
You know, when one looks at blocks data and what HNIs, etc., are doing, I mean, you're an institutional investor. What one is sensing is that people are willing to go down the market cap curve to look for that extra sort of delta, extra
that's the
juice.
Frothy part of the market now.
Yeah, but so what do you make of it? I mean, is it is it going to be? And we're seeing good, credible names. I mean, in lots of these sort of smaller companies, small caps is passé, it's micro caps now. Your sense?
So we're sticking to mid and large mostly. Small caps, we have probably about 10% exposure in some of the funds, 5 to 10%, not much. And in the blocks, probably we participate in 1 or 2 out of 10. So it's not like we're participating in everything. We're still being choosy about valuations.
But do you know why these promoters, investors are just checking out right now, selling so extensively? Is it just opportunistic? And then shouldn't it make investors wary, right? That they don't have the confidence to stay put at these levels?
See, some of them are known exits because a lot of the PE and VC funds which invested 3 to 7 years ago,
they have a shelf life.
They have a shelf life. They have to exit. And for most of the consumer tech, the ones that got listed about a year and a half ago, we knew that these blocks are going to come after 1.5 years. So that's not a surprise. Yeah. Promoter selling is there, but I don't think it's at alarming or extraordinary levels. So I think at some level, promoters will want to buy a bungalow in Luton's or something like that.
All right. Miran, on the positive front, we'll say the depth of the market as well has improved, right? The kind of selling that we're seeing is getting absorbed. I mean, I think your phone must be buzzing non-stop with the kind of large trades we're seeing, and a lot of them taking place even in the pre-market, which is safer. Yeah. There's no scope of slippage. I want to ask you about this power theme. It's come back and it's come back in style. Now, you could play it various ways. The Genco's overdues have come down, so you could play the financiers. You could play smart meters, you could play renewable. How are you all approaching this space? Because there's a lot of excitement out there and various themes to play it as well.
So we're still playing it mostly to gensets. The thermal theme is used to be the big theme. That's no longer a theme. And in the renewable space, frankly, there are very few listed companies that one can participate in. So the big action is happening in solar. So very few companies which are, direct exposure or indirect exposure to solar. Yeah. And probably even if they are there, probably they have some of them have debt issues and, legacy issues. Yeah. So apart from utilities, there are very few plays, frankly, in the power space because thermal is still not a big theme.
Thermal is not a big theme. Financials, Mihir, especially NBFCs, how much exposure do you have there? Are you increasing exposure to the NBFC space?
Yes, significantly more than what we used to have, say, 6 months ago. Especially, in the private sector NBFCs, of course, not so much in the public sector or
And which what kind of housing finance or is it
across the board? What we are seeing is that essentially retail lending continues to gain traction. There are still any alarming signs of NPAs building up in those pockets, and margins happen to be some of the best, especially in the low affordable housing and those kind of segments. Whether you talk about gold, affordable housing, even unsecured credit if done the right way. Some of the fintechs are now actually plays on retail lending. So those kind of themes are still building up. I think there is a bit of a penetration story here. And the trigger for us to increase exposure to NBFCs was basically the drop in funding cost, or at least the worst of the tightening behind us.
Is it a call on scale? Because, I mean, say, for example, for an HDFC Bank to go from whatever, 15, 20 lakh crores to 40 lakh crore book is going to be harder as compared to Bajaj Finance to go from 4, 5 lakhs to 10 lakhs. I mean, is that the call or is it purely tactical rates coming off so NBFCs benefit more?
I think it's more. I think we have given up trying to predict the end of the growth for the larger banks because I think some of the banks have continued to grow.
Because even a year back, the call was why go down the curve because large banks are available at decent valuations.
Correct. But then the valuation differential became quite sharp because private sector banks did quite well and NBFCs were almost available at one-time book. Even the private sector NBFCs were available at one-time book. So there was a bit of a valuation catch-up in any case and plus the funding cost trigger.
By the way, HDFC AMC is now up 10% right now. So it's getting very close to its 52-week high. I think the 52-week high on HDFC AMC is 2,314, hit on 20th of December of last year. And the stock currently is at 2250, so about 65 points away, 3% away on HDFC AMC. Look at that move on the stock. Do you think the regulatory overhang on the AMC companies may now be behind, given what the developments over the last 2 days, that even if we get the second TER, a new proposal based on the second proposal that comes through, it's not going to be as stringent as what the market was fearing? So do you think the worst of the regulatory headwind from AMCs is behind and stocks are attractive?
Hopefully, because the...
But you're not convinced, you're saying hopefully.
Hopefully, because regulatory, we need to wait for the final draft in any case. But valuations in this space had been beaten down. Some of the other capital market linked stories were also beaten down. For example, some of the brokerages, AMCs, they're all trading at much cheaper valuations than what they used to trade about a year and a half ago. So there is a bit of a value play too here.
So you would buy right now? Would you recommend adding on to positions, buying?
Yeah, in the sense, if it's a value buy, why not? Yeah.
What about how you're approaching this financialization themes? AMCs we discussed. There are exchanges out there. BSE suddenly it appears it's coming back into the limelight. After a while, doing the right things, getting some bit of regulatory support as well. You have MCX that unfortunately they have promised, but they have not been able to deliver, and that's been a big negative because the street was factoring that. And you have the unlisted NSE.
Which is depositories too.
Depositories as well. So yeah, so how would you play this? Financialization of savings or the stock markets as well? How do you play it?
That's a theme that has to secularly grow, frankly speaking. And I mean, you can pick and choose whether you want to be in an AMC or a brokerage or a depository. We have some exposure, not very high. So far, most of because as an insurance company, there are limitations on sector exposure. So banking itself and NBFC itself becomes so big that to add other financials becomes a bit of a sectoral constraint.
Correct.
What else, Mihir? I mean, any smaller sector where you think, it's still, lesser valued than it should be, where there is opportunity? In the mid-cap and large-cap space where you're comfortable.
Sure. So construction capital goods continue to surprise on the upside.
I heard you say construction, but you're talking about road contractors or?
No, even buildings. Even the private sector, capex in buildings, real estate. When I talk about buildings, I talk about office complexes as well as industrial buildings, hotels, hospitals is a big space. A lot of action happening from the government side in hospitals. If you look at some of the companies, they've got huge, because government has announced a lot of AIMs, etc. And a lot of work is happening in buildings. So I would say roads, buildings, infrastructure, that's one. And
stick with because there are lots. That space is
it's all mid caps. It's all mid and small caps. So you have to really pick and choose there.
So without naming names, I'll name names. There's KNR and there is it's a long line of companies. You're talking about those kind of companies,
so if you look at the quality so far filter. In our list, there are probably 3 or 4, frankly, which pass the quality test. I would say. And then the surprising part, or the positive surprise over the last few quarters, has been you don't see big bang project announcements. There's no major steel plant announced or fertilizer plant announced, but still private sector capex is picking up, which means it's the small units which are setting up capacities across sectors, whether it's pharma or electronics or textiles,
ethanol, sugar,
a lot of things happening in the MSME segment, which is adding up to all this capital expenditure. So cap goods also, I think, continues to surprise on the positive side.
We had the management of Thermax joining us, exactly making the point that you're making, that's the it's not lumpy.
It's
smaller
not lumpy,
orders, but which also makes it much more sustainable, hopefully.
Absolutely.
By the way, NBFCs are on fire today. Indiabulls Housing Finance 4.3% up, M&M Financial 4% up, Manappuram, Max Financial go down the curve as well. You're seeing some big moves in very large volumes. On the losing side, Tata Communication has trimmed some of its losses. It was down close to about 5%, is now down, I think, 1.7%. Pull up Tata Communication as well. Revenue boost, but there will be some slip coming through on the margin front. Mihir, what about pharmaceutical? There was a lot of interest in pharma when the index was close to its 52-week low. It had started rebounding. In fact, it was the first sector to lead the rally. But now, again, in the last 1 month, we're not hearing too many people coming out and say, buy now, buy now. Where do you stand on pharma and the individual subsectors in that?
So valuations are attractive. The call on pharma, I think, will be whether generic pricing pressure in the US has bottomed out. And if that happens, then there can be a big re-rating of the sector. I guess why pharma is probably not in the limelight over the last few weeks is because there's so much action happening elsewhere.
Outside.
You may want to, thank you very much for joining us, but you may want to listen into the next conversation we have. We have, the Minister of State for IT and Electronics joining us, Rajiv Chandrasekhar. Some of the stuff that you were talking about, manufacturing, capital goods, construction, I think sort of plays right there. Now, one of the big fundamental drivers for the optimism around India is basically the government of India thrust, asking companies to make in India, basically getting global companies to manufacture and set up manufacturing bases and factories in the country. And this has, of course, got huge multiplier effect on the economy. From PLIs to semiconductors to, large global corporations like Apple announcing aggressive expansion plans. Hopefully, it seems to be all coming together. We have Rajiv Chandrasekhar, Minister of State for IT and Electronics, joining us. He's, of course, spearheading many of these initiatives. Rajiv, good morning. Great to have you with us here. Thank you very much for your time. Prashant, this side. I just want to start with, the PLI schemes. And I want to actually focus our conversation on these three areas. One is, of course, PLIs. The second is semiconductors. And the third, of course, is what's happening with Apple, the largest company in the world, and what they've stated, which is having 25% of manufacturing out of the country. But let's just start with PLIs. Big program. Being run consistently for the last few years since it's been announced. By when, Rajiv, do you think we'll start to see the benefits of PLI coming through in FDI numbers? Like what we saw back in the 90s with China. That's basically going to be the big thing when that starts to happen. Or are you starting to see signs of it already? Go on.
Oh, absolutely. I think the signs are there for those who are looking. And certainly these plants that have come up today, we have large world-class plants that have come up in Tamil Nadu, in Karnataka, in Noida, in other parts of the country. And certainly there is, in my opinion, we have reached a stage or inflection point almost, where there is critical mass around electronics manufacture, specifically currently in the smartphone segment. And that is creating jobs, that's caused investments to come in. And more importantly, I think the almost total absence of India in the global value chains of electronics, which was the case in 2014, is now being transformed into where India is slowly and steadily increasing its share and presence on these electronics GVCs. And as you know, the electronics GVCs, apart from hydrocarbons, they are the second most traded commodities in the world today. The global trade of electronics about 1.6 trillion. And so our presence today is certainly a far higher presence, a far more significant presence than in 2014. All the major brands are certainly in India today and exporting. Both Samsung and Apple, the big brands, and then there is a slew of other brands that are smaller brands, including Indian brands. So I think we are at a stage where the PLI for smartphone has certainly translated into a very successful one, creating jobs, investments, and increasing share of the GVCs of that category.
Morning, sir. So I believe mobile phone exports from India crossed $11 billion last year, doubling compared to the previous year. What could that number look like in FY24? And secondly, we've got Apple, which has announced big grand plans, for setting up shop here in India. Are there proposals from other smartphone manufacturing companies to set up base here?
Look, the two biggest global brands in smartphones, as you know, are Apple and Samsung. Both of them have very, very significant presences in India. Samsung directly and Apple through its network of EMSs, Foxconn, Wistron, Pegatron, the network of companies that manufactures for them. And they are already here and they are really now focused on growing their volumes and growing their exports. We have last year crossed 1 lakh crores in exports, which is a significant number, considering that in just 8 years ago, we were not just not exporting, we were almost importing 82% of all smartphones consumed in India. So it's a dramatic transformation and a dramatic expansion, both in terms of investments and volumes and exports in this particular category. The other important thing to watch out for, and this has been part of Prime Minister Narendra Modi's strategy, is as the volumes pick up in the original category, that is the smartphone in this case, the underlying supply chain components and all of these feeder industries that feed into this very complex and sophisticated supply chain are also beginning signs to show investments and growth in India. So a lot of the supply chains that have traditionally existed outside of India are also showing signs of moving to India. So I think we are at a very, very good place, and there's a tremendous amount of tailwind for this category of products in electronics, which is the smartphone category.
So do we have the numbers of what the smartphone exports were in the first quarter of FY24?
I don't have the exact numbers with me, and so I don't want to speculate, but certainly we are on track to cross last year's by at least, as I understand it, at least by a factor of 35 to 40%. Last year, we were 1 lakh crores of exports. Smartphones are already the top 5 exported products from India today. So we've already crept into the top 5 as a category of exports. I don't have the exact numbers. There is obviously a certain lag between when the companies report the exports and when we get it. But I think we're on course to do a 40%, 35 to 40% growth in exports at the very minimum.
Rajiv, one of the things which some point out is that with assembly, we are actually capturing the last 1.5–2% of the total value of the phone. What's the plan? I mean, will this, with what we have now, will this eventually do you have visibility that this will lead to both backward and forward integration? I'm assuming that is the plan, right? To get companies to make here and not just assemble here.
Yeah, which is the point. Look, in the smartphone category, the making and the assembly are the same. What you are referring to is really the underlying sophisticated supply chain that creates the various parts that go into the end product, the display, the semiconductors, the PCBs, the discrete components, etc., etc. What is happening today is not just assembly as in just putting it together and just packaging it and putting it out of the factory. There is the whole manufacturing of the PCB, populating the PCB, testing the phone, testing the PCB. There is a significant amount of value that is being added in what you refer to as the assembly process, and I refer to as the manufacturing process. And the strategy, to explain the strategy to you, the design of the PLI was aimed as a two-step game. First, to just create the volumes for the product, the actual original equipment. And then as the volumes reach a critical scale, that creates an incentive for the supply chain, the components ecosystem also to relocate, to invest and manufacture in India to supply this. So I think the first phase of creating a credible presence, a trusted presence by India-made products in the global value chains has been more than established and has very successfully been met. And now the focus on the part of the government is to move the PLI impact into the ecosystem around the actual product, which is, like I said, you can see one piece of it is semiconductors, which you have already seen being rolled out and in play. And you will see now increasingly other parts of the component ecosystem also relocate to India from other jurisdictions or set up ab initio capacity in India.
Hi, good morning, Mr. Chandrasekhar. Sir, since you mentioned the semiconductor issue, I want to know what is the status update of that Vedanta Foxconn push out there. They have reapplied, I think the 28 nm node is what they have put out there. So could you tell us, as of now, how do things stand and where are we in terms of approvals?
Look, on the semiconductor space, there is a great deal of progress that have been made in the last 18 months across the ecosystem. So on design and innovation side, there has been tremendous amount of progress. We have almost 30 odd startups today that are creating next generation devices and chips. We have on the talent side made a lot of progress. We are just finishing the design and the final I's and T's being crossed on the research facility in Mohali. And on the fab and manufacturing front, you've seen the announcement for the Micron assembly plant that will be in Gujarat. It's a very, very big decision, very big investment in terms of strategic value. It's a memory player. And we see that as being value adding and adding to the products in smartphone and the IT hardware servers that are being manufactured in India and will be manufactured in India. On the fab, to your specific question on Vedanta Foxconn, they have chosen to reapply in a much more mature node, which is a 40 nanometer product category or device category. The 28 nanometer, I think they have been unsuccessful in terms of creating a technology partner or a technology alliance, which is obviously the critical part of a fab. And they have now reapplied as a 14 nanometer, more mature node, much more stable and higher yield technology. We are studying it. The proposal was only submitted a few days ago. We will study it and see if it meets our requirements of being a viable and credible proposal. And we will take our view on that with the help of all the external advisors that are part of the advisory board.
Rajiv, just a couple of more questions on the semiconductor bit. I mean, so Micron has been the first application which has been approved under the semicon scheme. So on that, right, again, I mean, as some have pointed out that the company is only putting in about $800 million out of the 2.75, which is the total cost. The rest will be borne by the center and the state. What's the plan? I mean, of course, the government had laid out a $10 billion incentive plan, and I'm assuming that is precisely for this kind of thing. Is the intention that once companies make here, there is the demonstration effect as well? It attracts more companies to come. So you got to give that initial thrust? Go on.
Oh, absolutely right. You are absolutely right. For the last 74 years, India has really not had any presence in the semiconductor space. We are currently in an extremely competitive environment with the US CHIPS Act, the Europeans with their CHIP Act, the Japanese with their aggressive incentive programs to attract semiconductor investments. So we are operating in a global environment where there is a lot of competition to attract these types of investments. And therefore, the government of India in December 2021 came up with this proposal where 50% of the capital investment made will be supported by a capital grant from the government of India. And Micron, which is certainly one of the biggest names in the memory space. And as you know, in any device today, any electronics device, it is really logic and the memories that constitute the silicon, the semiconductor population. So I think in that sense, it is a very important strategic investment for us. We believe that this investment will, in a sense, catalyze the ecosystem for manufacturing, packaging, testing, and verification going forward. And I must point out to you one thing for those who probably haven't understood this or picked this up, that packaging is about as critical to drive performance and innovation in future products and devices as much as semiconductor manufacturing. So semiconductor packaging is also a force multiplier for performance. And so therefore innovation and packaging around innovation around packaging is also a very critical element of the ecosystem that is being built today in India.
So just, one more point about that December 21, the semiconductor program that the government had laid out. It didn't really take off, right? Vedanta Foxconn didn't find the technical partner. ISMC partner was acquired by Intel. IGSS, which was one of the applicants, I don't think they met the requirements that the government had in mind. And then you all came out with another program. As you pointed out, this space right now is very competitive with the CHIP Acts in US and EU. So what's the government doing on that front?
Look, I think, at the risk of busting that bubble of cynicism, let me say this. Nobody who sets out to build a semiconductor ecosystem believes it's something that happens in a snap. It is a fairly complex ecosystem to build, especially for a country like ours, which has really done very little in the last 70, 74 years. And so therefore, we have always seen this as a multi-year roadmap that we are building. It is certainly not about instant gratification or instant headlines. I can certainly say that maybe we should have kept the window open initially for more than 45 days. That was maybe a tactical mistake that we made. And so the first round of proposals was certainly proposals that were, for example, the IGSS proposal did not cut muster with our technical advisory group. And so we've reopened the window. And like I said, I don't see this as something that is going to have only short-term goals. This is really a medium to long-term play about building an extremely competitive, innovative semiconductor and electronics ecosystem that in turn becomes a part of the global semiconductor and electronics value chains that is currently, as you know very clearly, is going through a process of being redrawn and redesigned as post-COVID people look for alternate destinations for their products and their devices. So I think I don't see this as anything but a natural process of being patient and building this ecosystem with focus and determination, which the Honorable Prime Minister has signaled from December 2021. The money is there, the capability and the intention of the government is there. And I think the world is currently certainly looking at India as a very, very attractive destination, both from a market as well as from an innovation and manufacturing hub point of view.
Right, and we wish you all the best. Thank you very much, Rajiv, for joining us. It's a pleasure, and we hope to have many more conversations along the way as efforts are on to build that sort of ecosystem for semiconductors here. First steps taken, first company and the plans with Micron approved by the cabinet. Well, we'll take a very quick commercial break here with the news that the markets are doing just fine. We have the management of Birla Corporation joining us next. The company's been a big winner, surging nearly 40% in FY24 so far already. After that, we have the management of Karnataka Bank to discuss the growth and business outlook. Stay tuned. The conversation coming up next.
Within retail loans, the fastest growth has come from unsecured personal loans, which was a new business for us. So last year, the growth was about 100%. And now it has become a significant part of our business. So the book grew from about 10,000 crores to more than 20,000 crores. Now at 20,000 crores, it is about a fifth of what your home loan book is. But because of the margins there, it is almost contributing as much to, again, NII as the home loan book is. So as this grows, and I think we can grow this book to about maybe 4x of its current size before it reaches levels which are with comparable banks, I think that's a big tailwind which is there in terms of margins as we go along.
No, that's where, I worry, because Reserve Bank apparently wrote a note to bankers and NBFC heads about unsecured loans and to asking you all to be careful. And, everyone is in retail, and one...
Well, time for our first corporate on the show. Birla Corp, that's one of the big winners this year. Stock has surged nearly around 40% in trade in FY24 so far. I mean, only a quarter in there. To understand how are things shaping up, Mr. Sandeep Ghosh, the Managing Director as well as Chief Executive Officer of the company, joins us on the show. Hi, good morning, sir. Thanks so much for joining in. Well, your stock price has been rocketing, and clearly there's a lot of interest for a large-sized company like yours on an EV per ton. Well, you're still trading pretty attractive at around $80 per ton. Want to understand a couple of aspects. First, on the demand front. Reports indicate that demand has been quite strong. So could you tell us what was industry growth, demand growth like in the first quarter? And also, how much better have you all grown in comparison to the industry? Go ahead, sir. Mr. Sandeep? Oopsie. All right. I think we'll have to, reconnect with Mr. Sandeep in just a bit. But clearly, that's been one of the big gainers. So we'll try to get more clarity in terms of, what's the view. Yeah, just the last few months up more than 25%. The move actually started in April. And now the street is baking in a better performance that's likely to come about in the coming quarter. All right. I think he's back with us. Hi, sir. Good morning. Mr. Sandeep, I hope our audio is reaching you now and we're audible.
Yeah. Thank you so much.
Lovely. So I was just congratulating you because the shareholders will be quite happy. In the last few months, your stock price is up 35 to 40%. So I wanted to understand that how has demand shaped up for the industry in the first quarter of this year? And how much better have you all grown in comparison to the industry?
Thank you very much for having me over and giving Birla Corporation the platform to talk to you. First of all, the congratulations, I think, should deserve to the investors, who have placed their faith in us, the confidence in us. We as management do our job, try to do our job to the best of our abilities, and we are happy if that is being reflected in our share values, as well as our, investors are getting rewarded for it. So that's a matter of satisfaction. Now, to answer your question specifically, industry volume growth has been, I think, quite healthy. We have been projecting for the year about everybody's projections seem to be that it'll be in the high single digits, 8 to 9%. First quarter, though, the growth we reckon has been in double digits. And we have kind of grown at par or thereabouts the market. You see, we are not really having a huge capacity expansion, so we'll be happy to grow with the market or marginally ahead of it, and that's what we are doing. In terms of the issue which will remain throughout the year is on pricing. Although there is there's a softening on the cost side, because obviously for fuel, one doesn't see prices really going up, but at the same time one would be worried for prices slipping. And therefore, we will look at the coming quarter with caution, because that's the monsoons, how things shape up, though there are certain other tailwinds which might help. So that's the balance. But one is happy between the healthy mix, between the healthy growth of volume, and as long as prices hold, it's, I think, a fair deal.
So why do you think there is a risk that prices may come down? If volume growth is in double digit, commodity prices are largely stable, what could lead to this cut in prices that you fear?
No, there are two things. One is, when I mentioned, is the monsoon. During the monsoon season, you do have a slackness in demand. But at the same time, I said there are certain tailwinds as well, because the kind of infra spending which is happening, you would have been reporting the growth one is seeing in real estate and housing right now. We expect with the elections down the line in the year, both the state elections in some major states, plus the Lok Sabha elections coming less than a year down the line, you will have a lot more spending on projects like Pradhan Mantri Awas Yojana and the rest of it. So those are good tailwinds. But one jury on the monsoon is still out. One is the absolute volume of monsoon, then the spatial distribution, and how it affects crops in various regions. But so far, the story has been, I think, encouraging.
All right. The last time Birla Corp spoke to us, Mr. Sandeep, the guidance that was given was volume growth will be closer to around 15% for this year. That's FY24 on the whole, with EBITDA per ton hovering around 850 rupees per ton. Now, we have a fourth into the year. I don't want to ask you about this current quarter, because obviously you're in silent period. But for the year, do you think those numbers are gettable? Volumes 15% higher, EBITDA per ton 850.
We kind of stick to those guidance, because you see, our volume growth mainly will come from our new commissioning of the Mukutban assets, which is near Nagpur, new plant. And the ramping up is going on well, and it's going according to plan, or maybe a little ahead of our expectations. And if the market in that region holds up, and if we see profitability in the market, there are two aspects. I'm quite confident the volume growth will come in any case, but then it will be a good boost to our bottom line, because there we have a lot of fiscal incentives which will start kicking in, and that's going to be beneficial for our bottom line.
All right, Mr. Sandeep, we don't get to speak to you very often, but what's the view on the jute business? Why don't you just get rid of it? I mean, it will be taking...
Jute holds a lot of promise for the future. And
okay, so you're positive on that. How do you see that business shaping up, sir?
See, there are two parts to it. What I was just now telling you, I think jute has a lot of promise, not just for us, for the country as a whole. I'm personally disappointed, that the country has missed an opportunity in not including jute in the PLI, because it's a geo fabric. jute would have been a great industry, and I think it's the opportunity missed even by the state government and the industry per se. That would have been a fantastic opportunity to turn around that industry, because today the demand for geofabric and eco-friendly fabric across the world, it is just booming. And unless we change our technology here, produce, innovate, produce better designs, new kind of products, we really will be missing the bus in the international market. So there is a huge opportunity there, and there is so much individual people can do. As far as we are concerned, we are making our small steps in that direction. Our jute exports of value-added products has increased, and we are, expanding in that market. We're trying to find niches like, coffee beans is one product where jute is used exclusively. So we are going into international markets in Latin America, in Asia, East Asia, where jute is being used. We are going in for shopping bags of high-end, supermarket chains and people who are moving into that. But that's, as I was saying, that there is so much we can do as individual, because it's not been a very profitable industry. But I think it has promise, and it would be both a fallacy or a mistake for a company to shed it, as well as I think we'd be doing a disservice to the national cause if a company like ours, which has been 100 years in this business, were to shed it just because it's maybe too small in the scheme of things. But to add to it, gives us a healthy bottom line for the size of his business.
Got it. Absolutely. I take that point, and well put. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. Thanks indeed. Well, I just want to quickly highlight, look at Nippon India. That stock, I mean, it was almost as if for the first 10 minutes of trade when we opened, it kind of forgot about the fact that there is perhaps some potential relief on TER regulation, and then it woke up. It's up 14%. It's basically surpassed. It's kind of a late reaction, a later reaction, I should say, but 14% on Nippon India at the high, not quite at the high point of the day, but pretty close. HDFC AMC, of course, is the other one, which is up about 12%. UTI AMC is the other one, right? I mean, these stocks were, where they started 1.5%, 2.5%, 3% higher. UTI AMC is also up 8.5%. So this is, I mean, clearly the big story of the day in terms of the market reaction. A hint, but a pretty clear hint from the SEBI chief that potential relief on the total expense ratio, and stocks are reacting big time. We'll, of course, hear details when that new consultation paper is put out. But for now, these are very large moves on large stocks. Rima.
Okay, let's move on then. The RBI released its biannual report on asset quality on Wednesday. The gross NPAs are at near decade lows for the industry. The system-wide gross NPA ratio came in at 3.9% as of March 2023, and RBI stress test projections show that NPL could further decline to 3.6% by March 24. So to talk about the banking industry, the loan growth, the asset quality, we're now joined by Sri Krishnan H., the Managing Director and the CEO at Karnataka Bank. Sir, before we get chatting about your loan growth, which was subdued in Q4 and how it's picking up in Q1 and hereafter, just a quick word on asset quality. Your gross NPAs were 3.74% as of March. Where do you see it headed by the end of this fiscal year?
Good morning, and thank you for having me on this show. By the way, just to let you know that I'm just about 3 weeks old in the bank. I've just taken charge on 9th of June, and this is again Mangalore, non-Kannada person to take over, reflects on how progressive the board has been and the bank has been. So just to kind of, it's not a disclaimer, but I just want to let you know that, we do have our results coming up, which is the Q1 results, same time next month when I'll be, happy to be on the show to talk about the results. But in a short, kind of an answer to what you asked, yes, the loan growth and the whole bank has been more traditional, and it has been subdued in terms of the growth compared to the market, and which is why there is a new management team that has been put in place. There is an executive director who's also new to the bank, and there is a whole lot of work that we are planning to do on repositioning and creating a new perception about Karnataka Bank to move away from a regional story to a national pan-India level story. If that gives you a sense of what we're doing.
Yeah, Mr. Srikrishnan, congratulations on taking over, and good morning. Prashant here. Could you then, because results are coming up and naturally you can't talk very short term, but talking slightly longer term smoothens sort of solves that problem. What's the vision, sir, for Karnataka Bank under you? In terms of, if you can just give us the big numbers that you want to get to.
So good question. So let me just tell you what we want to do. This is actually the 100th year of the bank. And as I walked in, we are actually having Centenary celebration. So we want to do two things. One is that on the 100th year, we want to have a 100th year startup of the bank, which will be the new bank, more digital, more focused on certain segments, which primarily would be MSME and retail driven. What it means is that today we have regional focus, which is comprising of about 14 economic pockets. And out of that, about 7 or 8 are in Karnataka, and the balance 6 are outside of Karnataka. So we want to really grow the business across, rather than being very inclusive only to Karnataka. That's step number one. Step number two is to enhance the digital delivery and also a digital acquisition, which is a very big thing. So there is a sector focus. There is also a kind of a channel focus that, we will bring about, which will contribute to two things. One is accelerated growth on the asset side. And this bank is known for, traditional customer service, where customers actually swear by the branch service and the excellence that, is provided. So which means that we need to capitalize on the inherent strengths of the bank. The inherent strength of the bank lies in credit evaluation and proposal, even at the branch level. So which means that a lot of automation and a lot of digitization that we can do to kind of enhance the bandwidth, as a result, enhance the volumes, and the asset growth and the CASA growth is something that, which will be a byproduct of all the efforts. So there is going to be the cash cow, which is the traditional bank running as it is. We are in the process of setting up a digital factory and analytic factory in Bangalore. And this would consolidate all of the tech operations, delivery, digital analytics, all put together. The bank would be far more outward looking compared to what it has been for the past 100 years. And while we celebrate our centenary, we'd also be kind of creating a startup and a complete sales culture, in the bank.
All right. Good morning, sir. You must be fresh in your role out here, but you have 4 decades of experience across the banking vertical. So, it'll be interesting to see delivery from here on. Give us a couple of numbers, though, if you could do that. You've clearly told us you want to expand geographically, and digital will be a focus as well for y'all. But I think the advanced book is close to around 60,000 crores odd. How do you see this number growing? If you have a target, say, in the next few years, where do you see this advanced number move to? Point number one. And also in the near term, that's for FY24, what kind of targets are you all working with, both on the loan book as well as on the NIMs, which were quite elevated for your low growth that you delivered in the past quarter?
Yeah. So two things. One is that, the asset growth, because of this efforts that, we've just embarked upon, we would believe that, between MSME, retail, and a whole lot of other gold and agri loans, and that's one thing that I didn't talk about, because the bank has also got lots of strength on the agri. We have over 100 AFOs in the market. And this basically would result in anywhere in the next 3 years crossing the 100,000 crore mark, which is for sure. That is one. And that's a very healthy gain. The second is that we need to be supported with some very good metrics on the liability side. And because of which, the healthy NIM, which it is, to sustain this at the same level is something that, we need to focus on. And over the last 2-3 quarters, I think, there is a significant improvement in the NIM. And we need to kind of at least maintain it at the same level. We are growing with the market, but not necessarily exceeding the market. And that's, I think, the fundamental change that we want to bring about, to say that there are those pockets where we can exceed the market in terms of the growth. So which will reflect on the numbers, both the asset as well as the overall balance sheet number. If that kind of gives you a sense of where we are.
No, but the NIMs, could you just the final question before we let you go? The NIMs margin, I mean, the guidance, if you could give us a broad band, last reported number is around 3.87%. So what do you think it should stabilize at, given the, go ahead.
That was a little bit of an aberration because of certain, clear pricing decisions that were taken in the last quarter. That was even before, I had come in. But on a steady state basis, we would, think that, the NIM would settle between anywhere because, as you're aware, the cost of deposits is always a challenge. And, that is something which is going to be, putting an impact on not only us, but all the banks. And so anywhere, a healthy 3.5 to 3.7 is what we would want to maintain. And I think we're quite confident on that.
We'll have to leave it there. Thank you very much for joining in. Wish you all the very best, in Karnataka Bank's century innings of 2.0. And we'll get chatting when you report your Q1 numbers. We'll slip into a break on that note. On the other side, we'll come back and talk technicals. Mitesh Thakkar will join in.
Starts rising, do you think that your very good record in bad loans, gross 3.7 or whatever, will that be in danger?
So I think the Reserve Bank of India is right to sound a note of caution, but it also depends where are you in terms of your balance sheet. So there are banks which have got retail loans as 50-60% of the balance sheet. For us, it is about 23-24% of the balance sheet. On the other hand, it is corporate loans which are 43% of the balance sheet. You add international of 17%, it is 60%. So the risk that comes to the bank really is from a disproportionate exposure to corporate. And as we increase the share of retail, the fact is we are de-risking the balance sheet because of the granularity that is there in the portfolio.
Okay. All right. So in your case, it turns out to be an advantage. But time permitting, come back to it. But what about growth? Are you seeing signs of the capex cycle? You did 16% in the just ended year. What do you think could be the goal for when Mr. Chand takes over in FY24?
The fact is you should always trim your sails depending on what is the direction of the wind. So there was a time over 2 years back when corporate growth was not there. So we grew corporate slowly, and that also meant that given the share of corporate, overall growth was also pretty much in line with the market. Last year there was an opportunity which was there because of the macroeconomic conditions. So our stance is that we will try to grow about 2% above whatever the market is, not having a fixed rate of growth, because there's no point pushing at a string, right?
But are you pushing at a string, or are you seeing enough hunger?
I think there is. So it is in what context? If you would take the context of the last year, I would believe there will be a moderation of the growth. If you were to take the context of the last 5 years, I think there's still room for an acceleration.
Okay, so 16 may be tough, but definitely at least 15, 14 would be possible, you think. Okay, the other point is credit cost. I mean, you have answered about asset quality, but this is an excellent credit cost, 0.4. Is that likely possible in FY24 as well?
So I think 2 parts to it. One is, to my mind,
or is there even space to go down?
Yeah, on a normalized basis, I would believe we should factor in about a 1% credit cost. That's what normal should be. Where we are today is because of a very positive improvement in the corporate credit cycle in particular, which continued even through the COVID period. I think it is likely to continue. This also gives us an opportunity. At some point in time in this cycle, the ECL norms will come up. To my mind, the fact where credit costs are gives us an opportunity to have overall costs, including ECL, within that 1% standardized figure, which means that the current trajectory that we see in terms of profitability.
Okay, welcome back. 115 points on the Nifty. We're at 19,000 and almost 19,100 for all practical purposes. Mitesh is with us with a quick view of the 45 minutes or an hour of trading that we've had and his fresh recommendations. Mitesh, morning again.
I think the trading has been very positive. Both the Nifty and the Bank Nifty look good. On the stock side, I think the housing finance companies have been doing very well, and we've earlier had buy calls on LIC Housing Finance. I think the India Bull's Housing Finance stock is also picking up very nicely. It's doing a good breakout. So buy here with the stop at 117 for targets of 128. And the other one is Infosys, which is open with a gap up there. That's a buy with the stop at about levels of 1300 for targets of 1380.
Okay, thanks very much, Mitesh. Appreciate you joining in with that. And that's the view coming in right now. We'll take a quick commercial break here. On the other side, my colleague Lata will get chatting with Manish Chokani of Enam Holdings to talk about the market touching record highs and what to do next. That's the question. Stay tuned. That conversation up next.
Largely be unimpaired even if ECL were to come in.
Okay, all right. Mr. Chadha referred to ECL, that is expected credit loss, which is a new rule that Reserve Bank is bringing in. You have to provide not just for loans already gone bad, but loans that may go bad, expected credit loss. We will have more questions for Mr. Chadha on that and on the digitalization experiment in BOB, which has succeeded so much. All that after the break.
To talk about the current position of Biparjoy, we are being joined by Mr. Sunil Kamble, IMD Head Mumbai. Thanks a lot for talking to us, sir. My first question to you is about the latest position of the very severe cyclonic storm, sir.
See, if you see the latest position on map exactly, you can see that northeast Arabian Sea, we can see the eye of the cyclone, and that cyclone is likely to move towards Kutch coast, and I mean it is likely to hit on 15th evening between Mandvi and Karachi.
Right, and that's a landfall, right? So
Yeah,
it's going to make a landfall there.
that is called landfall. So we are expecting landfall on 15th of afternoon.
So this image is this was taken at around 12:49 p.m. 13th June. This is the position of the cyclone, and so this particular cyclone was pretty unpredictable. It obviously, you know, posed a huge challenge to IMD also to forecast its path. If you can help us understand the trajectory, the track of the cyclone.
See, if you see this picture, you will come to know on 6th actually low pressure formation took place. On 6th itself, it has converted into the cyclonic storm, and we named it as a Biparjoy. And after that, it has become the very severe cyclone on 7th. Until this black, if you can see the black, it is the actual track of how, or the trajectory of the cyclone, how it has actually traveled. And at present, as on today, the position of this, cyclone is here. And what is the prediction? How it is likely to move? You can see with the red dots how it is likely to move. And as per the IMD forecast, this cyclone would like to have the, landfall on 15th between Karachi and Mandvi.
Right, so there are too many twists and turns when it comes to the path, because started northwards and then northwest, again northeast, and then again northwest, and again going to come back to our coast again. So my next question to you is about, you know, the impact of this in Mumbai. Is Mumbai going to witness?
Welcome to Market Masters. Of course, we have to have a Market Master because the Nifty regained its all-time high earlier this week and is shooting to new highs as we speak. Now, this feat is hardly surprising, what with the Indian economy chugging along as the fastest growing economy in the world, fastest growing large economy. Yet the new highs are coming at a time when the Fed, the ECB and the Bank of England look determined to slow down their respective economies. So should one be wary of the Nifty climbing at a fast clip from here on? Are there dangers of a sharp fall later this year as a result of the global rate hikes? Can Indian equities rally or at least outperform even if the world slows? What are the best sectors and stocks to bet on here on? I have with me undoubtedly a market master, Manish Chokani, Director Enam Holdings. Well, that is a very small description of a person who knows so much about markets. Manish, good morning and thank you very much indeed for joining us even as the Nifty is hitting new highs. But let me zoom out and ask you to parse the global economy for us. We saw the US GDP data getting upgraded, which means there could be even more pressing of the brakes by the global central banks. So does the latter part of 23 look challenging?
Good morning, Lata. Thanks for having me. You've given a very tough job to me with the amount of stuff you've laid out there. I'll do my best to try and put some things together. So taking the first question head on, I think the context for all investors is to understand that there is really a change of leadership going on in the world, where the developed world has become old because of demographics, and they've become highly indebted because of the amount of debt that they put onto themselves. And with the enormous amount of money printing which has been going on since 2008, and then just accelerated in this COVID crisis by just printing more and more. And that is showing up as something which is leading to inflation, because in real terms, their consumption basket hasn't gone up. So they've taken world GDP from, say, $80 trillion GDP to in excess of $100 trillion GDP. But all you're doing is you're paying 25-30% more for the cars you buy, or for the Starbucks coffee you have, or the hotel rooms you pay. Actually, it's a lot more than that. And that inflation isn't going away in a hurry. And like with most politicians, they want to keep kicking the can down the road. And the world's given a free pass to the Western world, because they have the reserve currency in the United States, the hard currencies in UK or Japan, and the European zone. So they've all been printing money freely until a time comes when this regime changes. As you're seeing with the steps being taken already with the triad of Saudi, China, and Russia on one side, and BRICS forming its other formation on the other side. So it's a game which will play out over the next few years. It's not something imminent in the next 6 months or 1 year, but you have to be cognizant of that. In that same vein, the leadership of world equity markets also will change, because when you look at market statistics, you'll still find this year that the NASDAQ has performed 25-30% higher. In fact, the CAC and the DAX, which is France and Germany, have also been up by a similar magnitude, as has Japan. So the countries which are actually not performing and going down, the money seems to be now finding its way to inflate the stock market values up over there.
Yeah.
And this to me seems like end stage, because the leadership is very, very narrow. As you see, NASDAQ, there are 7 or 8 companies holding the NASDAQ up. And profit numbers are at all-time highs. So they can only trend down from here as the interest hikes start biting into them and consumption starts slowing down. And on the other hand, you have India, which is coming off a low base, where the profit expansion is still starting out. And we went from a low of 2.5-3% of GDP to 4-4.5% of GDP as a profit number. But remember, we peaked at 7-7.5% in the first decade of this century. So we have a lot of headroom to run. Let me pause on that, and we'll take more questions as we go along.
Okay, well, I'll let you develop on that, because if the, initially Powell said that there will be more hikes, but it will be paced out. His latest testimony is that I won't take it off the table, even consecutive hikes. So, if that were to happen, I'm just asking you to look at the near term. Should we be prepared for something cataclysmic in the, not cataclysmic, something of a serious fall in the equity markets at all?
So look, if world equity markets are very well connected, so I can't say that if the world falls, India will not suffer. But having said that, India has all the characteristics to emerge as a leader. If you look at our PE multiples, I know people talk about our market being expensive, but if you can try and pull out a chart of the last maybe 8-9 years, you'll find India's PE multiple has just kept going higher and higher and higher every year, almost like a mid cap, which which is going to emerge as a large cap, because pretty much everyone in the world now knows this will become the 3rd largest economy in the world. You have to have an India allocation in your portfolios. A lot of people are still underweight India. A lot of fund managers, don't even know where the country is, because they were so obsessed with their own countries, or indeed only China. So this China plus one is not just happening on the manufacturing and supply chain side. It's also happening on the asset allocator side. And a wall of money is kind of going to be headed our way. And I think we'll be staggered with it. But naturally, if your home market's in trouble, I think people will pause, take breath, and then reassess and come back. But I would use that, and I think the whole world is waiting for that buying opportunity, that if India corrects, everyone wants to get in. And which is why this market just refuses to give up.
Okay.
So sure, there will be hiccups along the way, but I don't think there's anything cataclysmic, as you termed it, for India.
I get
it. If at all there is a dip here, I would encourage everyone to use this as a chance to get invested into India.
Let me use that wall of money that you mentioned. From 1990 to 2007, China had that demographic bulge, the demographic dividend. And the wall of money they got, both FPI and FDI mostly. Now we are at the cusp of that demographic bulge, in fact already there. So can you elaborate more on this wall of money? Are we going to see it both in FDI, FPI and even those GCCs, the middle office moving to India?
So if you think of it, there are a lot of global trends which are actually playing into our favor, and we've done a lot of preparatory work for that. So let me first lay the scene in India for you, that if India hadn't done all the work that we've done in, for example, cleaning up our banking system, the insolvency bankruptcy code where assets can turn, putting in GST and creating a common market, putting in RERA, which allows real estate to actually then be traded with a lot more trust in the system. Also the build out of infrastructure, which the government's of course focused on roads and rails and logistics to get them moving. And the private sector has played its own hand in terms of building out the telecom infrastructure, the ports and the airports and so on, power, and all of that is actually in place for almost like a manufacturing renaissance in India. Now juxtapose that with the fact that Germany is no longer getting cheap fuel from Russia, and that used to be the manufacturing powerhouse of Europe. And similarly, USA had pretty much outsourced its manufacturing to China. Now it's been a wake-up call for both US and Europe that we need to have a lot more resilience in our supply chain and less over-dependence on one or two not-so-friendly economies. And in that vein, you saw what happened with Prime Minister Modi also when he went to US, that they're going out of their way to woo India and bring them into the fold, where we become a reliable supply chain partner. So now the advent of, say, an Apple into India creates a whole new ecosystem for electronic manufacturing, the whole EMS segment, which is taking off, the work that Tatas are doing with them and building up almost like a new Foxconn in India. It unleashes what would have happened, say, 30, 40 years ago when Maruti came to India, or when GE came to India for the software services side. So it's a whole industry building out over there. And we're getting embedded into these global supply chains. And you have the skilled young manpower, which the world lacks. What's happened is after COVID, this work from home, people not wanting to work, they've got wealthy, they're just not showing up to work. You can't outsource it to China. Where do you go on scale? So while we were the back office to the world for IT, it's increasingly become the back office of the world even for other services. So, whether it's all the big five accounting firms or the management consulting, everyone is running their back offices on the services side in India. And I suspect this is slated to happen also on the manufacturing side. And we have done all the right things on a preparatory side with all the supply side reform in India to encourage all these players from overseas to come into India. So I think this trend accelerates. You will find a lot of money coming on FDI side. Private equity is sitting with a wall of money also waiting to be invested here. And of course, like I said, on the FPI side, I don't think there's a single investment committee in the world which is not actively looking to see how they can up their exposure to India. So it's a market which, like I said, each time there's a dip, there are 10 people waiting out, and each time the market gets slightly overpriced as we were 18 months ago, there's maybe 5 or 10% of the money or the chips are taken off the table, but they're finding the re-entry difficult. If you look back at October 21, when we were much ahead of time and we were almost at this 19,000 mark on the Nifty, FPIs I think sold something of $30 billion magnitude over the next 12 to 18 months. And now to put the last 10 billion, which has come in over the last 3 or 4 months, you're finding what's happening to the market. It's accelerating very rapidly. That's really the land.
I get it. I'm sorry I'm stopping you because I've also got to play to the gallery. And this is the Bazaar audience. They'll kill me if I don't ask you about how do you participate in this? I mean, do you, for instance, solar? There is no solar company, though we are going whole hog in solar. How do you play it? Do you buy ACs? How do you, play this so many jobs coming to India?
So again, let's step back once. That number one, I think as a country, we are underinvested in equities. Because if you look at your asset allocation and we save, say, $750 billion a year, while we are very excited with $2 billion a month inflow into SIPs, and it's maybe 20 billion, 24 billion a year, it's 24 on a base of 750. So it's 3-4% of incremental saving is coming into equity markets from Indian investors. So I think as a young India, where we are 27, 28 average age, the profile of equity in everyone's asset allocation has to be higher. You may pick your own companies. You should continue SIPs. No one can time the market. It is a high market. It's not by any means a cheap market where there's easy money to be made. But if you continuously keep investing into this market, which indeed a lot of young Indians are doing, I'd encourage you to get your asset allocation right, continue the systematic investment plan, then we have to worry about, do I do it myself or do I, look at sectors? By and large, the Indian fund managers are among the best in the world. I think if you look at records of people who run their funds for the last 15, 20 years, you'll find the compounding that they've done has been incredible. So there's no compelling reason for you to go out and say, let me jump in and make the money myself. If you like mid cap, you like small cap, by all means, you can buy those funds as well. However, if you do have a special edge, and like you said, if you're talking about solar, as just an example, the most obvious thing is not to go and buy the solar companies, but the people who benefit from that solar. Now, if you think of India, our Achilles heel has always been our lack of energy independence, and we were dependent on oil prices from abroad. But now with the changes afoot, where India is becoming a leader in solar and we're getting our power costs down, we have still not gotten rid of all our coal, and we are very, very competitive over there as well. A lot of the large materials companies in petrochemicals or steel or cement can use their own hydrogen, which they are creating to, in fact, lower their power cost. It may not yet be green. It may be gray, it may be blue, or whatever route they're doing. But when you take that along with solar, electrolysis, and you have the battery technology coming in, we will be at green, hydrogen earlier than people expect. So with this energy transition going on, it's making the country a lot more competitive. And as the currency gets stronger and the interest rates actually remain low, it makes the manufacturing sector a lot more competitive to become a larger exporter. So when you're thinking solar, the actually spin-off and the benefit may actually come to manufacturing. It's not necessarily going into solar directly.
Got that. So manufacturing. Now, the most important part will be what you're now looking at. IT companies are on the wane, and it's banking and finance, which has garnered a lot of investments. How would you play this? Is the past the prime in ITs? Do you still go whole hog in banks even at this stage?
So I'm not writing off IT, and we'll talk about it in a minute. But since you asked about financials, again, like I said, just sit back and think. If we save $750 billion a year, and we are still not even putting half of it into financial assets because it's still going into real estate and gold directly, as we financialize the economy and with what's happening with GST and everyone coming into the formal economy, even now with what's happening with OCEN, even the roadside vendor, when he's starting to get credit, the payments being tracked with what you're doing with UPI or with all your use of Paytm and other stuff. So all the flows are now being tracked, and therefore the economy is getting a lot more formalized. Formalization means it's a lot more financialized. And if that 750 billion of saving, which is also now compounding at the same nominal rate of GDP at 11-12%, the inflow into financial assets is very large. Within that, the share of the better run banks, it could be largely private, but also some of the leading public sector banks, their share of that trade becomes larger. And within that, the amount of products and assets which they can now, array in front of consumers is again mind-boggling. So you've gone from the typical housing loan to the consumer durable loan to then your unsecured loans. Also what they're doing on the corporate lending side. They also own actually all the insurance companies and the mutual funds. So the whole array of what I call financial sector is available to you. And remember, our largest bank, even after the HDFC and HDFC Bank merger, is going to be what, $160, $170 billion in a $4 trillion economy. It's a very, very tiny bank by global standards. The next straight SBI is going to be less than half of that market cap, which is our largest bank. So there's so much headroom. If you just sit and think, where does this go 10 years from here? You'll be actually boggled with the size of the banking sector in India, which plays both onto the retail consumer side as well as onto the manufacturing and infrastructure side. It's sitting right at the center of that. So this is to me the leader of this whole bull market.
Got that. Manish, that's throwing up more questions. How do you play this financialization? Do you buy AMCs and insurance and stock exchanges? How do you play these jobs coming to India? Do you buy more consumer discretionaries? All these questions are coming to Manish after the break. Bazaar guys will go on to Chartbusters, but this entire interview of Manish will play several times over after market hours. Stay with us.
particular cyclonic storm?
See, at present, cyclone is 700 kilometers away from Mumbai, and because of the impact of cyclone, we are likely to have the strong westerly winds at the speed of 40 to 50 kilometers per hour, gusting to 55 till next day. And because of this, we may have light to moderate rain at all the coast like Thane, Mumbai and Palghar.
But nothing alarming, right, sir?
There is nothing alarming. Light to moderate rainfall will take place because of the impact of this cyclone, and wind will be around 40 to 50 kilometers per hour till next day.
So Biparjoy is not going to impact Mumbai and the nearby region in any massive way. But talking about the advancement of monsoon, so we all are waiting for that. So when can Mumbai expect the onset of monsoon?
See, if we talk about monsoon, you can see the monsoons have advanced till today, till Ratnagiri. And as this cyclone is approaching towards north, heading towards Gujarat, at the same time we will have a southwesterly wind pattern and moisture, and accordingly we are expecting that maybe in next 48 hours we are expecting this monsoon will further advance in rest of the Maharashtra.
Right. So as the pressure will, as the system will move forward, that is going to be a favorable condition for the
onset of monsoon.
For onset of monsoon. So another thing, talking about the rainfall which we are expecting, especially Maharashtra, how is June looking like, sir?
See, as per the long range forecast, we have issued that monsoon will be normal, and especially in the month of June, we are likely to have some deficit 20 to 30% rain in Maharashtra, especially central Maharashtra. And how rainfall will be there in the month of July, that forecast we are going to give at the end of June, last week of June.
Right, sir. And this is also the month when, you know, sowing happens. So this 20 to 30% deficit, you think it's going to impact that, or is it way too soon to comment on that, sir?
Actually, it is very too soon to comment on it. We'll just wait for the onset of monsoon over Maharashtra, and then accordingly we can give the advisories to the farmers.
And in Mumbai, any tentative dates, sir, as in what IMD expects? When is IMD expecting monsoon to reach Mumbai?
See, actually Mumbai's onset date is 11th June, but now already 11th June has crossed, and all of us know that monsoon arrived at Trivandrum itself on 8th.
Right.
So, and because of the impact of this cyclone, we are not getting the moisture, or all moisture is getting sucked by the cyclone. So we are waiting to when the situation will improve, and we can tell everyone that when the monsoon will arrive at Mumbai.
Thanks a lot for talking to us, sir. So a lot depends on Biparjoy. Once this system will move forward, IMD will have more clarity on when exactly monsoon is going to reach Mumbai. In Mumbai, with camera person Milind Wagmare, this is Santya for CNBC-TV18.
A wind speed of almost 50 to 60 kilometers per hour, light drizzle. We are in Jamnagar, which is just adjoining Dwarka, which is one of the worst affected areas, expected to be hit.
Market scales a fresh record high for the second straight session. The Nifty rallies above the 19,100 mark, touches that all sectors except metals trade with gains.
Market regulator SEBI says it will publish a new consultation paper on the total expense ratio regulations after taking data shared by the industry into consideration. The chairperson also hints that mutual funds will be pleased with the new norms. AMC stocks surge in trade.
MCX renews its contract with 633 Moons even as it prepares to migrate to the new platform. The 6-month renewal will cost MCX 125 crore rupees a quarter, as a result of which MCX down 10%, 63 Moons up 14%. Brokerages downgrade ratings on MCX.
Tata Communications slips in trade, announces acquisition of communication platform services provider for around $250 million. The analysts say the acquisition is margin dilutive, but Tata Communications says it will help in doubling its data revenue to 28,000 crores by FY27.
ICICI Bank approves the scheme of arrangement for the delisting of ICICI Securities. Shareholders will get 67 ICICI Bank shares for every 100 shares held in ICICI Securities. The stock trading with marginal losses.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me today is Mangalam Malu. Well, Mangalam, a few hours before we get back into a weekend, so that's pretty good news. I love this truncated week scenario that plays out, right? Good weather, taking it easy.
Totally. I love it when Thursday is a holiday, because then the Friday, in the first half of the Friday, feels like a Monday, and the second half, it's a Friday. That's great.
All right. Well, let's move straight to the first guest we have on the show. PKH Ventures, that's a company in focus. They've come out with an IPO which opens today. They're looking to raise close to 379 crore rupees. Mr. Praveen Kumar Agarwal, who is the chairman and managing director of PKH Ventures, joins us on the show. Hi, Mr. Agarwal. Good morning. Thanks so much for joining.
Good morning, Najil. Good morning, Najil. It's a very good morning because the markets are nice. Yeah.
Good. I think it's a good time. You're making, good entry at a good time into the market. So wish you well on that front. But, a lot of investors out there, Mr. Agarwal, would like to know more about your business. Because you're in various verticals, right? You're in the hospitality space, you're doing construction, you're doing management services as well. My question to you is, what is your core competency and which segment of this business will you be stressing at in terms of growth from here on, say in the next few years? We don't want to ask you any numbers for this year, since you'll be under a bit of a silent period till you list, then we'll ask you all the numbers. But tell us, what's your core competency?
Sure. See, actually, we are a hospitality company. If you, from Bombay, everyone knows our first restaurant started at the Golden Chariot in the year 1993. But that, of course, was in a different company. Then we converted this in our company into a private limited company in the year 2000. And from there, our journey starts. And we have done so many famous brands of restaurants like Golden Chariot, the Balaji, and we have a few other brands which are doing very well. So we are primarily into hospitality and focused on hospitality. So there is some backward integration, forward integration. So we constructed our own hotel in the year 2014. The first hotel constructed in 2014. So that gave us a lot of experience of the construction industry, and we saw the execution problems in the high-end segment, which is a very niche segment to execute on time. So hotels require to be implemented on time, every time. So you can't be delayed, and there is a lot of shortage, and there is a lot of margin to be made there. So we slowly shifted a little bit towards constructing our own hotels. We have made 2 more hotels after that. But in between, in 2016, we got a great opportunity. We picked up a project, a government project, the first PPAC project in India, where we built the Delhi Police headquarters. It's a 10 lakh square feet project.
Mr. Agarwal, it's kind of you to run us through, the journey of the company as well, and that's nice to hear. But what is the core competency? From here on, what will you be focusing on? The hospitality vertical? Do you see a bigger growth coming in construction? Have you bagged any more orders in the construction vertical, say in this year so far?
Yeah, I'll tell you. See, so now we have completed project around 536 crores. And our order book currently stands at 450 crores till the time I can speak. All other things I can't speak, you know about it. So we are progressing at a very rapid pace. We have backed 3 hotel projects in the in Madhya Pradesh. Those are very prestigious projects. One is a palace hotel we are building. We have backed it for 90 years lease. It's a 400-year-old fort near Khajuraho, just 4 kilometers from the airport. So that we are converting into a palace hotel. Another hotel we are doing in Panna Tiger Reserve. That's a jungle resort. The resort is
Mr. Agarwal, yes. Right, Mr. Agarwal, we understand all the projects that you're doing, and the reason why we ask you about your core competency largely is because of this back and forth that has been happening, right? You said your core competency is when you started out as a hospitality company, thereafter you went into forward integration, some backward integration, and I see your businesses, there are so many of them, some of them seem unrelated as well. For instance, you have a non-agricultural vacant land in Thane. Secondly, you also have stake in one of the cricket teams which plays for the Mumbai Cricket League. Just wanted to understand the Namo Bandra Blasters, so to say. And on top of that, you have 38 related parties alongside the promoter group, which is looking to raise money. We just wanted to understand what exactly is going on out here, because chances are that maybe later going forward, you would merge them into your own company. You would take some funds out of this company, put them into your related party businesses. We just wanted to understand what's happening out here.
No. See what happens nowadays, every government project that you take, government wants it to be in a separate SPV. You can't have it in the main company. And it is good. We have structured it so nicely. Always every vertical shows different balance sheet, different numbers. So everyone is well aware of what is happening. It doesn't cover up into the main company. So every vertical, every SPV, like for example, this MP hotels, the government wants a SPV for each hotel. It can't be for 3 hotels also same SPV. So you must understand what happens. That is a requirement, and we are very happy with the requirement because it gives a separate balance sheet. The numbers are separate, so every performance of that,
Here's
so
where the concern is, right? You may be happy with,
we're organized. Every vertical has a CEO. Every vertical has.
Yes, Mr. Agarwal, we understand that. Yes. So from a reporting standpoint, you think it is a good structure for you to have for your company and the government as well. But here's where the problem is. On a consolidated basis, you have 85 crores of receivables on your books, of which 60 crores are from your related parties itself. And here on, you are looking to raise the funds that you are from the IPO and fund working capital for your own business. So in a sense, you're raising money from the market to fund receivables or working capital of your business, which actually is, in turn is your own business. We try to understand that. Yes, just a second. And yes, please go ahead, sir.
Sorry to interrupt you.
Go ahead.
Because our order book, what we are asking for a working capital is for a third-party order book of 450 crores. The working capital is only for that portion. It's very clear. So if you know the process of the RHP and DRHP, everything is so crystal clear. It is crystallized where we can use the money. There is a monitoring agency. So we can't use the money as we want. It's a very controlled regime. And we are always been very, very absolutely perfect on controls and regime. We are not bypassing anything. So you must understand that, first of all. It's not that we are going to bypass anything. So everything is very, very well defined, what we can use the money for and where we can use the money. There is not going to be any internal usage of funds.
Okay, all right. You've also mentioned that you could be looking at some inorganic growth from the money that you're going to raise. You've got a target in place, and will that get completed?
So I'll tell you what happens. So we are looking for some companies. So we are a specialized hospitality construction wing. So what happens, there are some specialized works like the HVAC works or the glass facade works, which we want to grow our internal capacities into. So we are looking for companies of that specific nature. If we acquire those companies will not be given to third-party vendors. That could be done by our own companies. So this type of companies we are looking to acquire. Small companies, not very big. We have kept only 40 crores for acquisition. So it's going to be third-party companies and very specialized company if we ever take. We are not identified.
What explains this revenue sharing with promoters that you have across all your companies? Because I look at it, and I'm paraphrasing from the crystal clear RHP itself, where you said the land on which Golden Chariot, the boutique hotel, is being developed by your own promoter. The company has entered into a revenue sharing agreement with the promoter by which 10% of the gross revenue of the hotel will be shared by a promoter on a per month basis with effect from March 1st, 2020. This is just one of them. Across all the businesses, you have revenue sharing agreements with the promoter, and this ranges between 5%, 10% to 30%. What explains this, sir?
So what happens when we are a family business? We are not planned this. That time we buy the land, and then now I can't have competing businesses within my own group. So everything has to be bought into this company. I can't have parallel hospitality running. So I am bound to provide all businesses into this company. So whatever market standard revenue share, if you take any other third party place, this is the revenue share which goes on, or more than this. So we have kept it absolutely at the minimum. It is not that we are going to take more revenue share or anything. It is absolutely as per market standards and even below that. 5%, 7%, 10% revenue share for the landowner. So there is no, this asset, company has not invested on the asset. So some portion of the revenue share goes to the landlord. That's what it is.
All right. Thanks a lot for joining in. We will, speak to you once again when the company lists with a bunch of...
Sorry. Yeah, I hope this point is well taken by you and your viewers, because this has to be understood. This is not by choice. These are all deals which has been done 10 years, 15 years back. So now there is no choice, but we can't have competing businesses. So that is why this structure has to be made. You have to understand this, please.
I speak on behalf of both of us here when we say that the market is the supreme, and eventually, the market decides what has been understood and what hasn't. We just put forth the points that we see in the research that you've provided to us with regards to your DRHP as well.
Yeah, and Mr. Agarwal, on listing, we look forward to having a more detailed chat with you. We'll try to get a few more numbers as well for the time being. We wish you all the best, and we'll hold you at your numbers as well. Look forward to speaking to you on the listing day.
We can't escape. Sure.
No, the market doesn't let anyone escape, sir. But
of course, I know that.
But yeah, it's good to have a chat with you. But as I said, on the listing day, we'll chat with you. Time to slip into a short break. Up next, we'll be joined by Manoj Jaiswal to get a technical check on the markets.
Which will make a landfall on 15th of evening. Now remember, today heavy to very heavy rainfall was experienced in several low-lying areas of Gujarat. Several measures are being put in place, even as it is expected that the wind speed will only rise tomorrow and day after tomorrow. It's expected to cross over 135 kilometers per hour. Along with heavy to very heavy rainfall in several locations on the coastline of Gujarat. As of now, the situation in Jamnagar, where we are around 50 to 60 kilometers away from Dwarka, which is going to be in the line of the cyclone when it makes the landfall. The situation here also seems to have been affected. We have been experiencing some heavy gusty winds along with a drizzle at several locations.
At Baroda Aerospace in Chennai, a new batch of drones is ready to be shipped out. The startup clocked 50 crore rupees in revenues from drone sales and services in FY23 and is now prepping for an order of 8,000 drones worth 323 crore rupees. Incidentally, these are only the drones received under the Kisan Drone Yatra, where farmers use drones to not only transport their produce to market quickly, but for crop assessment, digitization of land records, and spraying of insecticides and nutrients. With orders pouring in, Baroda raised $22 million in Series A funding in February, the largest mop-up by an Indian drone startup. These shipments, Baroda says, will catapult revenues into uncharted airspace.
We are looking at a very progressive and conservative target of about 450 to 500 crores next year, because we already have 320 crores of drone sales waiting to be realized.
Experts estimate that the farm sector alone could place drone orders worth 8,800 crore rupees in FY24. Orders from defense, big energy, shipping and steel companies could account for orders worth an additional 16,000 crore rupees. This has drone companies and their investors scrambling for more orders, more capacity, more efficiencies and more investments. The Indian drone market attracted investments of close to $50 million in FY23, and this in itself was 3 times the total investment that came in over the previous year. And it isn't just startups, but the more established companies as well that are gunning for a place in this pecking order. The opportunities, they say, lie across the board, from operating drones for agricultural and manufacturing applications to making them
Well, it's a great move that we're seeing on the markets once again, closing in on that 19,100 mark. A couple of stocks surging as we speak. Maruti Suzuki has moved to the high point of trade, up around 250 rupees since morning itself, closing in again on that 5-digit mark for Maruti, 9,800 on the stock. We'll watch out for Sun Pharma as well, up around 2.5%, Eicher Motors, TCS. So across the board, we're seeing gains, a little more reserved for the auto space, it seems, in today's trading session. But let's welcome Manoj Jaiswal for a quick technical check on the market. But Manas, every time we speak to you, we ask about the markets. We try to have fun with you as well. It's a Friday. The market's closer to 19,100 right now, and your initials are MJ. You want to show a short little move here for us on
one move, Manas.
One move, Manas. Let's do this. Let's do this for you.
No.
Come on,
Manas. Let's.
Not possible for me.
It can be just shake the shoulders.
Shake the shoulders. You can do that. Come on.
Friday mood, Manas. We can't get you on that. Let's get to your market call then, Manas. But maybe when the market is at 20,000, we'll have you do the breakdance maybe. So let's talk about the markets today. How do you approach it?
So, good morning, Nigel. Good morning, Mangalam. So, yes, Nifty has given a fresh breakout on the charts above 18,900. And it is looking very strong. Since morning, it is moving sideways, but the trend is quite positive. And I feel that even at current levels, one can definitely take a chance. Take a long position here. Stop loss should be around 19,000 on Nifty. I think after this breakout, at least Nifty can test 19,350. So, I think now, don't take position for next one or two trading sessions. I think you should take position for a week, and your target would be around 19,300 on Nifty.
All right, and individual stocks, Manas, what do you have for us today?
So yeah. So first one is the buy call on Bharat Forge, where stock has taken support near 20-day moving average, and today stock has given a fresh breakout above 825. So it is making higher tops and higher bottoms clearly on the charts. Take a long position in Bharat Forge at current levels. Keep your stop loss below 824. And here the target would be around 855. And second is a buy call on Emphasis, where stock has made a base near 1800, 1820 mark. Today stock has broken 20-day and 50-day moving average with decent volumes. I think here one can definitely take a chance, take a long call here. The stop loss should be around 1874. And here the target would be 1965.
All right, Manas, thanks a lot for that. Those are your market calls and the individual stock calls. But rest assured, we will keep pushing you to one day, dance on 20,000 for us. 20,000 for sure. And before that, if you do come to our studio some of these days, we're not letting you go without dancing.
Manas, for the time being, Mangalam's a good friend. He's going to do the step.
No, I'm not going to do the step. We'll reserve that for the Instagram.
20,000.
Let's move on. Let's talk about a segment where we get you ideas of profit coming in from our colleagues at Money Control Pro. Lekha Badlani joins in with a stock that she's been tracking.
Yes, so we think Sumitomo Chemical presents a good opportunity now, as the high channel inventory issues, especially in the generic segment, appears to have improved, and full normalization can be expected after Q1 FY24 for Sumitomo. Now, the company has strong growth potential on account of healthy product launches in the domestic market. In FY23, it rolled out 10 products which are expected to ramp up and would contribute to higher volumes in FY24. Now, Sumitomo is working on 5 proprietary products for its parent company, out of which one key molecule has been commercialized at its Bhavnagar plant in mid FY23 and is expected to contribute to the top line from the current year. Another project at the Tarapur site, which is for multiple projects, is expected to begin commercial production in Q1 FY24. Additionally, Sumitomo is working on manufacturing several off-patent formulation products for domestic sales as well as for exports. Furthermore, Sumitomo remains a zero-debt company with a healthy cash position. Now, the stock has corrected about 20% from its 52-week high and is trading at a PE of 34 times its FY25 estimates. We think there is a lot more visibility on the inventory situation now, and the short-term headwinds appear to be priced in, and the valuations have turned reasonable for long-term investments.
Thanks a lot for that, Lekha. Well, for the time being, just take a look at the bottom of your screen. Godavari Par, Nimesh had alerted us in his special segment, D Street Chatter, that could be some kind of a large trade. And bang on, Nimesh, hit ratio moving up, 2.5% equity changes hands. We'll try to get the management to comment on that particular trade. For the time being, slip into a short break, come back, continue our focus on markets and stock-specific action.
Companies expect the market for both drone procurement and drones as a service to multiply many times over, and they want to ride that slipstream. In Hyderabad, security and surveillance firm mCloud has forayed into drone manufacturing. After executing drone service orders for energy and manufacturing majors, it is now targeting 2,500 crore rupees in FY24 revenues from drone sales. In this, it is banking on the 70% stake it acquired in Bengaluru-based drone maker Scandron in March. Scandron makes 200 drones a month. But mCloud says this isn't enough. It is looking for land parcels in Hyderabad or Bengaluru to expand operations.
The manufacturing capacity has to be drastically changed to scale. Right now, we should be able to manufacture about 200 drones within a month's time. We need at least 10 acres of area because of the flying testing that we have to have, and different, if we have to scale to deliver like thousands of drones within a month.
Meanwhile, Mumbai-based IdeaForge is readying for a bumper IPO as it looks to deliver high-altitude drones to the armed forces. And in Chennai, IIT-incubated E-Plane is scaling up its production after receiving design organization approval from aviation regulator DGCA. There are over 100 drone manufacturers in India and even more drone component manufacturers. Every week, more such companies are taking off as they race for a piece of the market that promises clear skies and fair flying weather. In Chennai, this is Jude Sanath.
Today's Indianomics is on the transformation of Bank of Baroda over the past few years from a relatively ignored stock into a darling of even foreign funds. The current MD and CEO Sanjeev Chadha has an enviable record as a bank MD. When he joined Bank of Baroda as MD in the last quarter of FY20, Jan 2020 actually, the stock price was around 90 rupees. Today, as Chadha ends his term, the price is 190 rupees. In FY20, the bank had managed to eke out a profit of just 546 crore rupees. In Chadha's last year, FY23, the profit is 14,110 crore. The gross NPA then in FY20 was 9.4%, FY23 3.79%. Net NPA then was 3.13%, latest year 0.89%. Credit cost then 1.82%, now 0.4%. Sanjeev Chadha.
Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, a few stocks are firing away as we speak. Emphasis, that one's moved to the high point of the day. Just pull up the intraday chart out there. That's spiking up as we speak. And a couple of other names as well. Amara Raja. Wow, just take a look at that move. Big spike up is what we're seeing on that stock. On the flip side, you have Manappuram Finance that was holding with good gains. It seems to be a little bit nervous getting into the weekend. So that one has moved a little bit lower. But we've completely run out of time with this edition of Chartbusters. That's it from Mangalam and myself. You stay with us. Trading Our Team comes up next.
When the financial merger of Vijaya and Dena banks into BOB had just been completed, but he had to see through the integration of personnel and extract synergies. Chadha was also taking over from P.S. Jayakumar, who was the only instance of a private sector banker to become the MD of a PSU bank. In the 2 terms of Jayakumar and Chadha, Bank of Baroda has been noticed for accelerated digitization of services and for a lot else. To discuss how Bob has transformed in the past few years, I have with me the man himself, Sanjeev Chadha, Managing Director and CEO. Good morning, Mr. Chadha. Thank you very much for joining me. Well, actually, that is the first question. You know, very briefly, what are the 2 or 3 things, or maybe 5 things, that has changed in BOB over the last 5 years?
So I think for any transformation, first there needs to be an opportunity, and then there needs to be an agenda. So I think the opportunity was there because, as you mentioned, Mr. Jayakumar had really come in and brought a lot of change, and initiating change is always tough. The second was that there was a merger which was underway, and it is only times of transformation where then you can really give it momentum. Third, I believe, was COVID, which was a watershed, which had also allowed you to do things which otherwise would have been more difficult.
What did you observe over the 5 years as different?
So I think 4 or 5 things. One was, of course, the fact that coming from SBI, I think the central challenge was how do you make sure that you can get talent? Because if there was one thing which was different, it was SBI, of course, has a great model, homegrown talent, but what could you do in BOB? And I think it was a very pleasant surprise that that Mr. Jayakumar had initiated that change. We were getting people from outside, and as you progressed, you found that it was actually possible to get first-rate talent bank and to retain that. So I think that was the first element of transformation which was there. The second was technology, which was very important. Now we had made investments in technology, for instance, through a data lake, but ultimately it's important that technology gives you results, it touches the customer. And there with COVID, there was an opportunity to actually bring about a very wholesale transformation. That's where Bob World came in. Third was, I think, a performance culture, which is very important. And that's something that we were able to build. Now, if you talk to any of our people and ask them about how their branch, how their zone, how their region is doing, people have, again, the important performance metrics, even at 3 o'clock in the night, if you were to give them a call, right? And the fourth, I think, is important is, again, a governance agenda and a strong sense of ethics. We brought in Dr. Mukund Rajan to help us, again, construct a ethics agenda for the bank, because that is something that really is the bedrock of change that can be sustained. So I think these are 4 or 5 things which were there.
Let me take each of them in detail. One thing you didn't mention, and which other Bank of Baroda old-timers told me, is that you've also introduced, or maybe with Jayakumar, I don't know, a collection mentality. I mean, until very recently, growing the balance sheet used to be the goal, but you gave a lot of stress to collection.
So I think it was really identifying that what were the missing pieces, right? And one of the missing pieces...
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay and Pavitra Parekh. And girls, the party's on Dalal Street. There is no sign of a hangover. There is no sign of stopping this. The bulls are in complete control. 19,100 on the Nifty as we speak. Up more than 100 points. The Sensex has raced away to a near 500-point rally. Mid-caps are moving in step. They don't want to be left behind. And today, bulk of the leadership is coming in from the IT names. So pull up the Nifty IT index, and that appears to be going into its earnings with some strength. The Nifty IT index is up nearly 2%, with heavies like Infosys, TCS batting for the bulls. In fact, even if you go lower down, you've got Tech Mahindra, Wipro up close to about 1.5%. And this was a point that we were making earlier. The economic data coming out of the US has been so strong that that's raising the question that whether we are truly going to see a recovery in the sentiment in the second half of the year. If you remember, over the last 2 days, you got the Q1 US GDP data, 2%, much ahead of street expectations of 1.4%. It was revised higher. All 23 large US banks passed the stress test. It was the financials which led the decline, led to those cuts in discretionary projects during the Q4 earnings. So the sentiment was roiled by the US banking crisis. But if the US banks are now in a good position, maybe they will start spending, and that will get reflected in the IT numbers. The first half is going to be weak, but what about the second half in FY25? Can we expect a recovery? And this is something I think the street is now taking note of, the strength in the US economy and expectations of a recession being pushed back even further. So look at the way these IT stocks are now reacting to the economic data.
Oh yeah, absolutely. And IT has been one of the pillars that has led the rally this week. I mean, for the week, the Nifty is up 2.3%. The IT index is up well over 3%. The other big contributors to the rally this week, it's been a shortened week, just 4 trading sessions, but it's been enough to get the bulls really high and happy. So it's been pharma, it's been IT, and it's been auto. These 3 big sectors, they have pretty much led from the front. And that's 7 days, 1.5%. If you're looking at the last 4 trading sessions, then the Nifty is up about 2.3%. And IT has, of course, played its part. Beyond IT, I just want to come to today's gainers list to look at what else is helping the market today. So some of the auto names are still revved up nice and strong. As I said, it's pharma, IT and auto. 3 sectors that have been rock steady for the market this week. And it's more of the same trend that we're seeing. That's the contribution chart. So you'll see more of the heavyweights there, like HDFC. The bank Nifty is actually holding up okay, 0.5%. Now let's pull up the Nifty gainers. So M&M, let's flip that plate and show you another set. You'll find Maruti on that list as well. There's Hero Moto, there's Tata Motors, there's Aisha Motors. So autos are hot and revved up and in top gear. There's no other way of putting it. So that's a very, very strong part of the market. Banks are all right. I mean, HDFC Bank is holding out positive. There's some buying on the non-banks like Bajaj Finance and SBI Life. There's SBI, which is holding up. Then there's ICICI Bank on the way down. So that's where some of the profits are coming off. But otherwise, the Bank Nifty is holding up pretty okay. That's the trend so far. The mid-cap index is holding up about 0.5%. But I guess some of the biggest headlines, Pavitra, today coming from stocks that we usually don't talk about. The AMCs, look at what's happening there.
They're completely excited on, on the news that came through from SEBI on Wednesday on the TER, regulations being deferred and looking at a fresh draft as well. So HDFC AMC up 12% right now. Take a look at any of the others. Aditya Birla is doing very well. UTI AMC is up 8%. So definitely a lot of excitement in that pack. There's also a lot of, we'll actually talk more about that in just a bit. We'll also talk a little bit about the block deals because that party is not stopping either. So you have something like a TD Power, which is up, Credit Access, which is, seeing some cuts right now. So those stocks in focus as well. Today, the big move, of course, is on IT with the 2% gain. Rima was mentioning the large caps. Take a look at some outside of the index as well. So, seeing gains between 3 to 5% on a lot of these names doing very well over there. On the downside, there are some stocks on news, right? The likes of MCX, which are seeing a big cut. So that is something that we will take you through later on the show. And the entire Adani group of stocks also seeing some red today. So that is the shape of the market right now. We're going to keep coming back to this because it is clearly, in good form, and we're going to keep talking about that. But first up, let's start off with our top story here. Market regulator SEBI on Wednesday cleared several key proposals at its board meeting. This including revising the listing timeline, FPI disclosures, as well as the much discussed TER regulations. So Yash is here now with a roundup of all of the highlights that really came through from this meeting. Yash.
Well, Pavitra, very importantly, there were 3 points which were most important from the market point of view, which came from SEBI board meeting. 2 of them were expected. The third one was completely out of syllabus, so to say. And let's talk about the surprise itself. No mention of total expense ratio regulations in SEBI's outcome, which was expected by the market. But when I asked the SEBI chairperson in terms of what has been the status on that, there was a very clear and a crisp answer from SEBI chairperson saying that there has been a round of consultation with the mutual fund industry on the total expense ratio regulations. There has been feedback which has come from the industry in terms of granular details on how economies of scale has been passed on to customers. SEBI very clearly saying that they are willing to take this feedback under consideration, revise the current existing draft consultation paper on TER regulations, and a new draft consultation paper on TER regulations expected to come out in the market soon. Why does that come as a relief for all AMC players? That one sentence from SEBI chairperson makes all the difference, where she says that the new draft consultation paper on TER regulations, the industry looking at that paper will be very, very pleased. So that one was an important one. Apart from that, strict FPI disclosures have come in. These are for ultra risk FPIs, essentially granular details on ownership, economic interest and control will have to be furnished with market regulator SEBI. Which FPIs qualify under this thing? FPIs holding 50% of Indian equity AUM in a single corporate group. The second condition, FPIs which hold more than 25,000 crore of equity AUM in Indian capital market. The third and the final one which came from SEBI's board meeting was reduction of the IPO timeline. As of current regulations, if the IPO closes today, T+6, which means on the 6th day is when the listing happens and trading commences. SEBI is proposed to shorten this to 3 from the current 6 days, and this will be done in 2 phases. Essentially, in the first phase, it will be a voluntary shortened listing for companies that will be on or after September 1st, 2023, and a mandatory process will come into place from or after December 1st, 2023.
Steps that have been announced, and I guess the big one is going to be this new TER disclosure. But yes, just on on the FPI regulations, the additional granular details that SEBI is asking for. So in cases like you described, where let's say an FPI is owning more than 50% in one single Indian listed entity, so wherever these thresholds are being breached, how much time has been given to the FPI to come out with the disclosures? Because that might be quite important for some of the listed entities from various groups, perhaps even including the Adani group.
Correct. So there was a consultation paper on this thing. As far as the final details in terms of how much time would be given to disclose the granular details on beneficial ownership, that will only come out once the final regulations are released by SEBI. But more importantly, it's important that all details of beneficial ownership of these FPIs come out, which is what the SEBI has made it very clear. Of course, the timelines will have to be satisfied by market regulator, and the specification on that is expected very, very soon.
Okay, all right, got that. Thanks very much, Yash, for the details there. A very important board meeting and late night action actually on Wednesday, just before the market holiday. Let's hear out the SEBI chairperson on a lot of these important issues, and then we'll come and pick it up on the other side.
Proposal was discussed in depth, and the board finally advised SEBI to go back and publish it as another consultation paper. Reason being that, as I had mentioned earlier in some forum, that unlike our normal proposals which are done by way of co-creation with the industry, since this was a price-sensitive subject, we did it with the limited data that we had and without the benefit of the data that the industry had. So once our consultation paper was there, then naturally industry came back with their granular data. Now when we saw that granular data and said, okay, we now understand this, so therefore a lot of the things that we had built into and baked into our original proposal needed to undergo a change. We modified the proposal, and the proposal was actually, I think the industry would be quite pleased to see the new proposal. And therefore what the board said was, look, the proposal has undergone significant change because, as we described, we had more data, new data, and therefore we obviously, as I've always said, that the data will speak. So our policies will always rely on data. And therefore the board advised us that publish your new proposal, which you have put to the board, publish it again to the industry, and let us see now with this fresh proposal, which is quite different. Let's see what the feedback is.
Okay, so there the SEBI chairperson really giving lots of hope to investors in AMC stocks, and we're going to be discussing this on Who Moved the Market. Remember, it's our digital offering. We go live on YouTube and on Twitter every day at 2 p.m. Why are AMC stocks rallying anywhere between 5% to as much as 15%? How should investors be prepared for the final TER changes? Remember, the final norms are still not out. Do catch this if AMCs interest you, of course, as investors, as well as, of course, participants in the mutual fund setup. So 2 o'clock, we go live with experts. Join in the conversation. We'll take a quick break on that note, come back on the other side. And then we put the spotlight on the banking space. Remember, the big development there, of course, is the HDFC-HDFC Bank merger. So what lies ahead for this behemoth? Pranav Dheeraj of Sanford Bernstein will join in.
Look at what is it that, where are we away from the best? One was in terms of growth rate. Public sector banks have been losing market share. The second was in terms of margins, right? They are lower, which are as compared to others. Third was in terms of, again, the asset quality. Right. Part of the asset quality is, of course, cyclical, and we have seen some of the upside from there. But fundamentally, if you want a sustainable transformation, it is the collection mechanism which needs to change. And what we found was, as compared to some of our competing banks in the private sector, the kind of resources that you deploy for collections, again, were suboptimal. And also, again, it was as a discipline not developed. So among the people that we brought in, we also brought in, again, a head of collections from a private sector bank who had been doing it for 20 years, built a large team. And particularly now, as we go into areas like unsecured personal loans, you go in for new to bank customers, I think it's very important that a collection machinery actually precedes, again, going aggressively into any business rather than succeeding that.
The other thing that clearly has succeeded, and you alluded to it a couple of times, the ability to integrate lateral recruits. I mean, now even the government is advertising for joint secretary level lateral entrance, but that's a new thing. That it has succeeded so much is a surprise.
So in some ways, you always try to do different things and see what works. So there are businesses which are not native to public sector banks, right? There are disciplines which again we have not really developed as well. And the question is, how do you actually acquire those businesses? How do you build those businesses? One way is to get a consultant and help you do it. But what we found was it was a far better idea and something that works far better if you bring in somebody, but somebody at the top, because it means that you bring in experience. You also bring in the ability to attract a team around that person who's building that business. And that's something that becomes a sustainable business model.
But won't you disturb the salary hierarchy?
So I think the fact is that the third pillar that I mentioned, performance culture, once you build that performance culture where everybody believes that, look, they do need to perform, there is no option, then people actually start coming to you themselves and saying, look, this is a gap that is there in my capability. Why can't we get somebody from outside to fill that capability gap?
Okay. Oh, that's good if lateral recruits have integrated so well. I'll come to these long-standing issues in a bit because the stock market will also want to hear from you the more immediate performance targets. One, your NIMs. As I said in the beginning, it's a superb improvement. I think it's the best in many years. But is 3.5 or 3.6 maintainable?
So I think there are some structural factors which are at play, which I believe should help us bring about improvement as we go along. There's no doubt that we again at a very fortuitous point in the cycle. But for us, for instance, again, you will find that it is the retail loan growth which has driven growth. So last year, overall growth was something like 17-18% in loans, but the retail growth was 27-28%. And that is something which is significantly margin accretive, in the current context, because corporate loans, again, margin.
Welcome back. You're with us on Trading Hour, and as promised, we'll get the discussion going on the HDFC-HDFC Bank merger. Remember, the boards are going to be independently meeting, and we're expecting this to take effect sometime in July. Dheeraj Gundlapalli, Senior Research Analyst at Sanford Bernstein, is with us now. Dheeraj, good morning, and thanks so much for joining in. You know, we were discussing this internally even earlier, and our colleague Abhishek was telling us that there are a lot of merger synergies. Obviously, hopefully the merged entity will have lower cost of funds, lower operations, so maybe better margins. I guess the consensus is that we should not see too much pressure on asset quality. ROA, as Abhishek was telling us, should be pretty steady around 2%. But you tell us, when you see this merger from a bird's eye viewpoint, are there any near-term merger risks that investors should be aware of as we get to the event?
Good morning. Thanks for having me on the show. So I think on the mergers front, there are quite a few nitty-gritties around the immediate impact of the merger because it's such a big shift which is happening, and also something which hasn't happened before at this scale. There are always concerns around, let's say, what happens when you merge this large NBFC into a bank. There's an accounting change. There are pricing changes for the mortgage loans. A lot of these things which are still an overhang. But when we look at the numbers and see what these could mean, we don't see any one factor which could be large enough to really cause the bank to slip on their promised ROA of the 1.9 to 2.1% range, right? So yes, there are quite a few unknowns, but none too big to put a risk to the promised 1.9 to 2.1% ROA target for the bank.
Pranav, the other big question is, can HDFC Bank, HDFC Limited, with a size of more than 20 lakh crore, which is going to be double that of ICICI Bank, can it continue to grow on such a large base at the same pace? And if that's, if size is going to become a problem in, for the bank to grow, then does it make sense to look at other private sector financials?
A good question there. So I think we don't see that as a concern, and two reasons really for that. One, going ahead, the real constraint for growth is going to be deposits, right? So assuming it's a universal bank that we're talking about, the constraint is going to be deposits. And in deposits, across markets, what we have seen is that the large deposit bases grow as fast, if not faster than the market. So the idea of a smaller deposit base growing faster has never really worked out, other than in cases like India, where you had a large public sector banks, which were happy market share donors because of various reasons. Otherwise, the large deposit bases have always grown faster. That is one. The second also is that if you look at HDFC in the context of private sector banks, what really happens with the merger is the immense scale difference that comes up. Right? So you're talking about HDFC being twice the size of ICICI. And we believe that the next leg of growth, credit growth, will come from the revival in the corporate segment, right? And in that segment, the size of the balance sheet becomes a key differentiator. So sitting with 2x the balance sheet, you have a natural right to win that is far superior to that of any of your smaller peers. So that again helps them in terms of growth. Lastly, again, going back to the deposit question, if you look at the way deposit base has been growing for HDFC versus its peers, it's easily been growing at 4 to 5 percentage points faster than its peers. And that's enough to keep the loan growth at the same pace as peers, if not faster.
Pranav, thanks for joining us. So, like you were mentioning, we've seen this outperformance by HDFC Bank versus pretty much all of its peers, right, on deposit gathering. Do you think now with the merged entity, there will be, that continuation continue? I'm talking about the big outperformance that we have seen. Do you think that will also hold going forward? And also, if you could just help us with how you expect some of the other metrics, the NIMs, etc., to really look post this merger.
Right. So I think the 3% outperformance, into 3 percentage points outperformance, I think will continue or would have continued even without the bank doing too much. But then you also have the bank adding aggressively on the branch front and really shifting its own internal focus to deposit gathering. So I expect that gap to actually widen going forward. That is one. And in terms of the metrics near term, I think near term there will be a NIM decline for the merged entity, right? So the 4.1% NIM would probably come off by about 30 to 40 basis points to 3.7 to 3.8. But that will be immediately offset by lower operating costs, right? So the OPEX to assets ratio for HDFC Bank is about 2.1% today and will drop to 1.7% right on the day of the merger. So you have an OPEX ratio which declines and offsets the higher cost of funds. But over time, as the bank gathers more deposits and gets back the deposit ratios to be in line with its pre-merger levels, that cost of funds differential or the drag will decline, whereas the OPEX differential is almost a permanent thing, right? I mean, you're getting that because of scale, and scale is not going to go away. So you will see a scenario where it can generate a sustainably higher ROAs than its peers.
Okay. So Pranav, I'm just looking at your note right now, the latest one that you had. You've got a price target of 2,300 on HDFC Bank with an outperform rating. As the street digests this merger and this behemoth, comes into being, leave us with maybe 2 or 3 key points that investors should monitor. And do you think that even now, is perhaps a good time to get in? And where would you rank HDFC Bank within your, top banking choices?
Okay, so I think in terms of the thesis, why now and why it's still a good time to buy, I think the short-term thesis for HDFC is that the long-term picture will come back to in focus, right? So there's a lot of uncertainty, noise around the merger. All of that should get addressed within a quarter or two post the merger. And then the focus shifts to the long-term story for the bank, which I think is rock solid, right? So you have a scale advantage, which will play out. And therefore, once that comes back to focus, you will see a big re-rating there. So to us, the short-term story as well is just that the long-term story comes back to focus. So that's really the thesis here. And in terms of the pecking order, really we're quite bullish on the large banks in general. We see a strong compounding story for almost all the large private sector banks and even SBI for that matter. And HDFC is right at the top of our rank order simply because beyond the compounding story, there is this re-rating which will happen as the merger-led overhang lifts, right? So I think that's really what puts it right on top of our rank order, followed by the others like Axis, where there is a slow re-rating which could happen as the bank narrows the gap it has built versus its peers, right? So as that operational performance gap narrows, you will see a slow re-rating coming in. And then you have SBI, which I think is a reflection of our positive view on the sector, followed by the view that when corporate comes back, the banks with the larger balance sheets will have a greater right to win, and SBI kind of fits very well into that team. So those would be our top 3 picks in the sector amongst the larger banks.
Pranav, great conversation. Thank you very much for joining in. Look forward to chatting with you far more on CNBC TV 18. Thank you once again for joining in. We'll slip into a break. When we